Hello people, happy morning. So today we are continuing our marathon discussion. So let's quickly revise investment decision topic with the help of our short book itself. Now, investment decision and working capital management are usually considered to be our big ticket topics in FM. Usually 8 marker or 10 marker, anything beyond 6 marks if comes, usually they'll pick from either this topic or working capital management. That's usually the way ICI prefers it. Okay. So now let's see what we can learn from this particular topic. Now, investment decision. Investment decision ka whole funda is we'll have to take a few decisions over here, like whether to buy a new machinery or not, whether to buy a new fixed asset or not, or if you already have a fixed asset, should we replace it with a new asset? Should we take up a new project or not? All this decision comes under the scope of investment decision. Now, investment decisions we take with the help of a particular technique. That technique is what people? Capital budgeting technique. That's a technique used basically for our investment decision. Capital budgeting is not a method. It's basically a name line, tagline given. Under this capital budgeting, we have various methods. Okay, that's what we have to keep studying. Why this investment decision is important is, now these sort of investment decisions, right, they're not pretty straightforward. Like, just to give you an example, let's say a company wants to buy a plant and machinery. They have two options. One, they can buy it locally. They can buy it in India itself by paying how much money? 8 crore, and the life of the asset will be 8 years in this particular case. And if you buy a local machinery, you can use that machinery for how many hours a day? 10 hours every day. Now there is another option. Same machinery you can import from 9 crore by paying 9 crore from Japan, but the life of the asset is what? 8 years, but you can use it for 12 hours a day. Now the question is, should we buy it locally or should we go for import? It's not pretty straightforward, because all this, once you buy an asset, this amount, 8 crore, 9 crore, small amount to big amount. So this investment decisions involve a huge capital outflow. 9 crore, 10 crore, 100 crore, 500 crore, like this. So the impact of all this is quite big, and it is quite on the long run. Because see, once you take a decision, you have to keep that decision for how many years here? 8 years. That's not a short period at all. So hence, we need to be a little careful while taking the decisions. Hence, certain techniques were required for us to help us in making this particular decision. That's all we'll be doing in this particular topic. Okay. Now, people, majority of, like as I said, capital budgeting is just a name line. Under that, we have various methods. Majority of the methods, some of the methods you already know. What are those? Payback period, accounting rate of return, NPV, IRR, MIRR, profitability index, etc., right? All those are methods under capital budgeting. Almost every method that we see under capital budgeting works with the help of cash flow. They don't take the decision based on profit. Decision is based on cash flow. In majority of the problem, investment decision problem, cash flow will not be given. We need to find the cash flows. They will usually give sales. They will usually give the data for sales. Now, from sales, we'll have to arrive at cash flow. Now, people, you already know from sales, how do you get PAT? Tell me that. From sales, how do you arrive PAT? Once from sales, you will reduce variable cost. Variable cost, if you do, you will get contribution. Contribution minus FOC, fixed cost. All that exact format is not required over here. From sales, if you reduce all expense. From sales, if you reduce all expense. All expense could be your variable cost, fixed cost, interest, everything, depreciation, everything put together. From sales, if you reduce all expense, automatically you will get earnings before tax. From that, you reduce tax, you will get earnings after tax. This earnings after tax or profit after tax, another name is net profit. Whenever in the FM they use net profit, or for that matter, even in accounts, if they say net profit, it is always profit after tax. Till here, normal protocols. Fine. After this, what do we do is, since we need cash flow, now people, is depreciation already reduced? Yes. Why we need to reduce depreciation? Because depreciation is a expense. It is non-cash expense, but it is still a expense. All expense first you need to reduce, then only you will get profit before tax. No, correct? Then only you will be able to find out the correct tax amount. To find correct tax amount, we have to reduce all the expenses, including depreciation. But we need profit here or cash flow? cash flow. Because of depreciation, you've already reduced depreciation, but because of depreciation, cash outflow happened, or it's a non-cash item? Non-cash item. Hence, once you find out PAT, first adjustment you'll have to do is depreciation. You need to add back. Why? You have reduced it here. For the purpose of determining tax, you have already reduced depreciation. But if you reduce 1 lakh depreciation, did cash go out to the extent of 1 lakh? Or it's a non-cash? Non-cash. Hence, what do? First adjustment, what we do is add back depreciation. Got it up, people? Because why? What's the logic of that? It is a non-cash expenditure. That is the reason. And we need cash flow over here. That's one. Another one is we used to remember in class. So this we'll call it as OVAS. We'll remember it as what? OVAS. After depreciation, 4 adjustment. N grow OVAS. O for opportunity cost. W for working capital. A for additional capital introduced. S for salvage value. It could be subsidy. It could be, or it could be STCL or STCG. I'll tell you all of this in the problems one by one. Okay, now people. So it's a normal question, but since they will not give you 1 year data, like here in my example, what was the useful life of the asset? 8 years. That means you need to estimate the cash flow for 1 year or 8 years. 8 years. Hence the problem can become lengthy, because all this step you have to do not just for 1 year, you have to do it for 8 years. After that, you will get the cash flow, and then you can apply the respective capital budgeting method. So this becomes a working mode. Everybody got it? Everybody got it? Just to be on a safer side, quickly I will recap this OVAS adjustment. Then when it comes to the problem, again we'll discuss a little more. O for what, people? Opportunity cost. Opportunity cost here simply means sacrificing cost. Like here, I used to give the same example in class if you remember. Now I'm teaching. My full-time profession is now teaching. Am I working in corporate now? Sir, if I was working in a corporate, I would have got corporate ka salary. Corporate ka salary. Let's say my salary would have been 30 lakh. My salary would have been 30 lakh. Let's assume. Okay, now you're getting excited. Just an assumption. Okay, 30 lakh, let's say, used to be my salary if I used to work in corporate. Now I'm getting this 30 lakh or gone? Gone. That means that becomes what, people? Opportunity cost. Opportunity cost means the cost of letting go something. Done. Now here you tell me this 30 lakh income I am getting or not getting? Not getting. In cash flow estimate, no, how do we do it is, if it's an inflow, we show it as a positive number. If it's an outflow, we show it as a negative number. Okay, now you tell me this opportunity cost of 30 lakh, I should show it as positive or negative? This 30 lakh, I should show it as positive or negative? Now this, if I used to work in corporate, I would get this income. Then I would have written plus 30 lakh because I would have got this income. Now I'm getting this or letting go of this. I mean, this income is reducing. Income is reducing. Income is a positive number. That is getting reduced means I should show this 30 lakh here as a positive number or negative number? Negative number. So basically in my example, opportunity cost, you will show it as minus 30 lakh. Done, people? But in some problems, my opportunity cost can also be a positive. Opportunity cost ka signs could be on the positive side or it could be on the negative side. It depends on the question. Okay, here one income I lost. In my example, one income I am losing. Hence, I am showing it as what? Negative. Suppose I avoided one cost, Andre. I avoided one cost means what? Positive or negative? Cost is an outflow. That I am incurring or I am avoiding. If I avoided a cost means it becomes a benefit. Then it will become opportunity cost will become a positive. So you have to read the question. One income you are losing or one expense you are losing. One expense if you are losing means it will become a positive number. One income if you are losing means it will become a negative number. So you have to read and accordingly figure it out. Hence opportunity cost I have written plus minus it because it depends on the question. So O is comfortable. W for working capital. Now people, whenever we do a project, like let's say now we want to open a branch in Hyderabad. If you want to open a branch, we want fixed asset also, right? Fixed assets like furniture or TV, AC and all we need to invest. Only that alone is sufficient or we need some money for day-to-day operations also? We need to invest some money for day-to-day operation also. That means when we need to invest? After 10 years or now? Now. Hence, whenever they give you working capital, at year 0, you will take it as what? Negative number. Year 0 means what? Now. When am I investing this working capital? Future or now? Now, hence, and investment means, if I'm making the investment means money is coming in or money is going out of business. Money is going out. If money is going out means positive or negative? Negative number. Done now. Now, once we do a particular project, will we let go of that working capital investment or we'll recover that also? See, business means whatever investment we have made, we want to recover. Yes or no? So, initially at year 0, working capital will be negative. At the end of the project, working capital will become a positive because we would like to recover. Actually, working capital recovery can happen any year. It can happen in first year, second year. Suppose project life is 5 years. Project life is 5 years. Working capital recovery can happen in year 1, year 2, year 3, year 4 or year 5. Any year. But it will not be given in the question. Which year working capital got recovered will not be mentioned. Hence, in FM, we make a normal assumption. What is that? End of the project, we will recover. This is just a convention. But actual recovery can happen any year. But for our problems, what we'll do at the end of the project? In my example, what is the life of the project? 5 years. That means year 5 working capital, you will take it as a positive because you are recovering this. Done now. That's your W. O over W over. A for additional investment. Sometimes people, when you're doing a project, you will have to invest entire money at year 0 or you may have to invest in installment. You may have to invest in installment. Maybe let's say 10 crore rupees at year 0, 1 crore rupees at the end of year 2. Possible. Investment also can come at multiple installment. So this year 2 ka whatever you are investing, that we are calling here as what people? Additional capital or additional investment, whatever. It will be given to you in the question. These are not that frequent. Some questions will have it, some will not have it. If you have it, bring it in. Yes, people. Additional amount if you are investing means money is coming in or money is going out? Going out. So positive or negative? Negative. Last is S. S for salvage value. Now people, when we have a desktop, right, to do this particular, open a new project in Hyderabad, new branch, we have purchased a, let's say, computer. Computer will come forever or a few years. Let's say computer ka life is 4 years. Computer ka life is 4 years. At the end of 4th year, what we'll do? Now this is not of much use to us. At the end of 4th year, we will sell it. When we sell it, we will pay the money or get the money. So salvage value outflow na inflow na. Salvage value is an inflow. You will get it every year or only once? Once. Usually at the end of the project. Dana? Hence at the end of the project, you will take salvage value as a positive number. That is one. And or it could be a subsidy case also. Subsidy means, again, there is a rare adjustment. Sometimes government has some initiative to promote a particular sector, etc., etc. Now, government is giving a lot of benefit for MSME sectors by giving loan at a lower rate. They're giving a lot of benefits, right? Like that, if you're getting any benefits from government, show that also. That question will specify, if at all it is there. Danaji, the question will specify when you will receive also. You may receive at year 0, year 1, year 5, whatever. So, based on that. So, now you tell me this subsidy we are paying to the government or receiving from government. Hence, subsidy will show it as what? Positive number. Which year? Question will specify. Okay, I've just written end of the project here, but it could be whichever year as per the question. That is one. STCG, STCL, I'll take up a little later. Leave that. STCG is your short-term capital gain. STCL is your short-term capital loss. I'll take you through one question later. This, if you do, finally you will get what, people? Every year ka cash flows. Now, based on this, we do some adjustments that we will see each method onwards. Done now? Okay, give me a walkthrough of this. What have we studied so far? All the methods. Basically, this technique we call it as what? Investment decision ka technique. We gave a fancy name. What is that fancy name? Capital budgeting. Under capital budgeting, we have various methods. Majority of the methods does not use profit. They use cash flow. And cash flow will not be given to us and we need to estimate. What they will give to us in the question? Some benefit like sales and some expenditures they will give. So from sales, how do you derive cash flow? First take sales and reduce all the expenses. Whether it could be variable expense, fixed cost, depreciation, doesn't matter. Reduce all the expense. You will get profit before tax. Reduce the tax amount. You will get profit after tax. That only we call it as PAT, EAT or net profit. From net profit, 5 adjustments. Every problem. First, add back depreciation. Why? Depreciation we have already reduced, but cash did not go out. So hence it's a non-cash expenditure. So add back. After that, OVAS. O for opportunity cost. W for working capital. A for additional capital investment if required. S for salvage value or subsidy. Okay. Opportunity cost can be positive or negative. If it is income avoided, if you have lost in income, then opportunity cost will be negative. If it is cost avoided, then it will be a positive. Then W for working capital. At year 0, you will invest working capital. So at year 0, working capital will be negative. At the end of the project, we will recover it. So it will be a positive. A for additional capital. Additional capital will be an outflow, which year question will specify. It can come in any year as per the question. S for salvage value. Salvage value is an inflow only at the end of the project. Subsidy again can come at the any day or any time as per the question. By that, you will get the cash flow. Okay, people. Now, can we go into the techniques one by one? Okay. You updating anything, Ada? Okay. All right. Now, let's go for the one technique. Sir, if it's easy technique, we will just take a small example and finish it off, right? So, if it's a major technique, whatever we say, we'll apply in some problems. Like that, we'll try to cover the almost everything. Okay, first technique of investment decision is, people, or rather, if you want to segregate capital budgeting techniques, broadly they're classified into non-discounting techniques or traditional techniques and discounting techniques. Non-discounting techniques, discounting techniques. Non-discounting technique means they don't give a damn about present value, future value and all. They just take the number as it is and work out. So that means here we use discount factor to find the present value. How do you find present value? Take future value of cash flows, multiply by the discount factor. Yes, no. That's how you get the present value. These techniques don't need the help of discount factor. Hence, they are called as what? Non-discounting techniques. Under this, we have payback period, ARR. Payback period and ARR. Payback period. First technique, payback period. Payback period means, name itself is saying payback period. This particular method is trying to say, in how many months or in how many years we will recover our initial investment. In how many months or in how many years we will recover our initial investment. That only is what we call it as payback period. Comfortable, people? Okay. Now here, if, again, as I said, this particular, almost all capital budgeting techniques works based on profit or cash flow. Cash flow. Now you need to check if every year ka cash annual inflow, every year ka net annual cash inflow, whether it is constant or fluctuating. If every year cash flow, if it is constant, means if it is same every year, means then payback period is simply given by the formula initial investment divided by annual net cash flows. If every year cash flow is same, means payback period is simply given by what? Initial investment divided by annual cash inflow. Like over here, check. Initially, we have invested 12 lakh rupees. When did we invest this? Year 0. How much have you invested? 12 lakh. Let's say NCF. NCF as in net annual cash inflow. Every year net cash flow is how much? 3 lakh. Now use your common sense. Payback period means in how many years will you recover your initial investment, which in this case I have assumed it to be 12 lakh. And every year you are recovering 3 lakh means in how many years will you recover 12 lakh? 4 years. Not only payback period is given as formula. Now tell me the formula, how did I get 4? 12 divided by 3. That is nothing but initial investment divided by net annual cash inflow. You can use this formula only if the net annual cash inflow is constant every year. If it is same every year. If it fluctuates means, then we have to use something called cumulative approach. Like look at this example. Project ka life is 5 years, I assume, and every year ka cash inflow same or changing. Change. Initial investment is same. How much is initial investment? 12 lakh. Now is cash flow same every year? No. So formula will not work. We have to find something called what? Cumulative cash flow. Cumulate means, the name itself is saying accumulate or cumulate. Cumulate means adding up. So how do you find cumulative cash flows? This we need to find out, or in these cases, this will be given to us in the question. Cumulative cash flow, how do you find? Just by adding the cash flow. First year, anything to add or only 1 lakh? So first year cash flow will be same. Second year, what will be cumulative cash flow? First year ka, second year ka put together. So 1 lakh plus 2 lakh, how much is that? 3 lakh. Next it will be 3 lakh plus 4 lakh, how much? 7 lakh. Next it will be 7 lakh plus 5 lakh, how much? 12 lakh. 12 plus 6, how much? 18 lakh. Now how much did you invest? What is your initial investment? 12 lakh. Any year is having this number 12 lakh, check. Yeah, at 4th year we are able to see 12 lakh. That means what? We are able to recover our 12 lakh within 4 years. That directly a payback period. Manageable. That's your cumulative method. Okay, Sarji. This they will not ask. Let's assume initial investment is 14 lakh. Let's assume initial investment is 14 lakh. Now check any number is having 14 lakh in cumulative column. No. So now what to do? Last problem, it was very easy because 12 lakh exactly you found that 4th year. So therefore payback period itself is 4th year. But now we have modified initial investment to be how much? 14 lakh. 14 lakh, are we able to see it here or not able to? So how to solve in that case? Now check, up to 4th year, how much have you recovered? 12 lakh. Up to 5th year, how much have you recovered? 18 lakh. But we want to recover how much? 14. Can I say 14 lakh falls between these two? That means it falls somewhere between year 4 to year 5. So that means we can conclude payback period is somewhere between year 4 to year 5. Somewhere between year 4 to year 5. Now you can do that cross multiplication and do it as I have shown in class. Or for exam, we will use simple formula. That is much easier, right? So in this case, what you have to do is, payback period is between what to what here in my example? 4 to 5 years. Take the lower number. What is the lower number among year 4 and year 5? 4. Start with that. 4 plus required cash flow divided by actual cash flow. Lower number plus what? Required cash flow divided by actual cash flow. Now people, we are at till 4th year, how much have you already recovered? 12. How much we want to recover totally? 14. From 12, if you want to go to 14, how much we want to recover more? 2 lakhs more. So required cash flow will be, start with the lower number. What is that? 4. Plus required cash flow will be what? 14 lakh minus 12 lakh. How much is that? 2 lakh. Divided by actual cash flow. For 5th year, what is your actual cash flow? 6 lakh. Either you can do like that or 18 minus 2. How much did you recover? 6 lakh. Do this. How much are you going to get? 4.3 years. Yes, simple thing. Done now, people. That's how you calculate payback period if the numbers don't exactly match. Lower number plus what? Required cash flow divided by the actual cash flow. You can use this. I've shown you other method also in class, but that's fine. That's a logical method. But I think this works better for examination. You can do it faster. This is your payback period. Any doubt in first technique? Easy. Now we will not take up any question on this. We have already covered everything with an example over here. Pretty simple. Okay. Usually if this question alone comes, it will be for a 2-marker. Otherwise, they will club this with a bigger question. Like that. They will ask 4-5 methods and make this payback period as a 2-marker question. That way also can be asked. Can we move on to the next technique, people? Under traditional technique only or non-discounting technique only, there is one more method called ARR. Or maybe I'll cover off this first. This is not really a technique. It is just an extension. Payback reciprocal. People, you have done maths. How do you get reciprocal? Ulta. Reverse. So payback reciprocal means it will be reverse of payback period. So payback reciprocal, how do you get? PR. 1 divided by payback period. If you found out payback period, let's say payback period is 5 years. Payback period is 5 years. How do you find payback reciprocal? 1 divided by 5, which is nothing but your 0.2 or 20%. That's your payback reciprocal. Okay. All right. Now, why do we find payback reciprocal is, some people have done an analysis that payback reciprocal will be almost equal to IRR. It will approximate to IRR. IRR we already discussed in cost of capital, right? So payback reciprocal will be approximating to what? IRR if one condition holds good. If life of the project is twice the payback period. If life of the project is 2 times the payback period. Now suppose payback period is 3 years. Payback period is 3 years. Let's say project ka life is, let's say, 7 years. Project ka life is how much, people? 7 years. Okay, now check what has happened. If you find payback reciprocal will be more or less equal to what? IRR, provided one condition holds good. What is that one condition? Life of the project should be at least 2 times of the payback period. Do 2 times of payback period. How much are you getting? 6 years. That means project ka life should be 6 years or more. It should be, the keyword there is at least. At least means 6 years or more. Here, what is the life? 7 years. That means there is another shortcut way to find out IRR. So can you use this in problem? Don't. If they ask IRR, do use your normal interpolation formula. Only if they ask payback period. Usually this gets asked as a theory. 2-marker theory they ask. Explain payback period. For that I have written 2-3 points. Okay. And don't say I will find payback reciprocal and call it as IRR. You will not get marks. When they ask IRR, do in the normal fashion. This is just for theory in examination. Done, na, sir? So this is basically an extension, not really a method. Next one is something called ARR. ARR means accounting rate of return, or also you can call it as average rate of return, or also known as book value rate of return. Any name. Same, everything is same. Now people, you can find ARR in three ways, right? One is a faltu one. We'll not use it for exam. Leave that. We'll explain two methods. One, and first, before that, sir, ARR is the only capital budgeting techniques which uses PAT. ARR is the only capital budgeting technique which uses PAT. Rest all the techniques use cash flow. ARR is the only thing which uses what, people? PAT. So ARR is simply given by the formula. Method 1 to find ARR is take the average PAT. Take the average PAT divided by initial investment. Average PAT divided by initial investment. That is method number 1 to find out ARR. Second method, take the average PAT in the numerator divided by the average investment. I feel this is a better comparison, because numerator if there is average, denominator also it should be average. But ICI books allows both. Okay, people. But this is easier for exam, because initial investment will be given to you in the question. Average investment we have to find. So your call what you want to do. Fine, both are acceptable as per ICA. Or if you want, you can go one step ahead and solve under both the methods and ask the examiner, you choose whatever you want much. Like that also you can leave it. But both are acceptable. Yes, sir, people. How do you get ARR again? Average PAT divided either by initial investment, or you can use average investment, your choice. How do you find average investment? Actually, a simple formula to find average investment is initial investment plus salvage value divided by 2. That's all it is actually. Initial investment plus salvage value divided by 2. I proved this to you with an example in regular class. Leave that, right? But our ICA will not use this. They have a fancy formula. To find average investment, it is half, 1 by 2, half, open the bracket, initial investment, here I've written, minus salvage value, close the bracket, plus salvage value plus working capital. So we'll be using this only for our examination. Fine. For testing purpose, if you want, you can remember, you can just check in case you forget this formula, or if you're not sure whether what answer you have got is right or wrong. Simply you can do initial investment plus salvage value divided by 2. The numbers should match. Fine, people. But you don't use this for examination. How do you find average investment? This way only. Okay, not any other way, because our study material does not recommend this. Only this. Done now. Okay, one more I'll point, I'll tell, maybe I'll take you through one question as well. First of all, how do you find average PAT? If they give you 5 years ka PAT, how do you find? Now, this method and all uses time value money concept or no time value? No time value. That means you can use simple average. No weightage wala drama. It is simple average. How do you find 5 years ka simple average? Add all the years ka profit divided by 5. If any year has a loss means, profit means you will add, loss means you will subtract. That's all. Add all the profits and divided by the number of years. That will give you what, people? Average PAT. It's a simple average because there is no time value money concept over here. That is one. Now, another way this particular question can be asked over here is, sometimes they will not give you average. Sometimes they will not give you PAT. In the question, they will not give you PAT. They will give you cash flows. What they will give you? Cash flows. They will give you cash inflow and they will give you cash outflow. Cash outflow will happen at year 0. Cash inflows will happen over many years. Like that they will give 5 years, 10 years ka cash inflow they may give, and year 0 ka cash outflow they will give. So how to do it? It's a simple interpretation. If they don't give PAT, but for ARR we need PAT, but they have given cash flow. How to get it is very simple. Cash inflow, you will interpret it as income. Cash inflow, you will interpret as what? You will use it as a income. Cash outflow, you will use it as a expense. How do you get profit? Income minus expense. Income minus expense. But they will give you 1 year ka income or let's say 5 years ka. They have given you how many years income? 5 years ka. That means what you will get. Tell me, how do you calculate here? If they give you 5 years ka income, and if they give you 5 years ka cash inflow and year 0 ka cash outflow, what you will do? Add all the 5 years ka income. That way you will get income for 1 year or 5 years. So that's what is the first thing I've written here. Take the total cash inflow minus what? Total cash outflow. When you do this, you get average PAT or total profit. Since this is total cash inflow and this is total cash outflow, you will get the total profit. You want total profit or average profit? So how do you get average profit? Take the total profit divided by the number of years. In my example, number of years was 5 years. So by that will become your average PAT. This is a substitute. This is not actual way to find PAT. This is a substitute way just to work out the problem. Done, people? This is another way through which they can ask. These are the two ways ARR adjustment can be asked. Otherwise, ARR is pretty straightforward adjustment. Any drama? Sorted. Paka? Is it okay? First, I will run through all the methods and then we'll take up all the questions. That way we can revise the concept once more if required. Comfortable with you? Okay. Can we move on? That's about ARR. But remember, ARR doesn't use cash flow, it uses PAT. That's only, hence the name. This is the accounting rate of return. In accounts, maybe we don't work cash flow. We have profit. Correct? Okay. Done. Next. Next people are discounting techniques. Previously we saw non-discounting techniques, or another name, traditional techniques. They used discount factor or no discount factor? No discount factor. But discounting techniques will use the time value of money concept. So under this discounting techniques, you will see NPV, profitability index, IRR, etc. etc. So first discounting technique is NPV. You've already done this, people. Tell me, how do you find out NPV? Present value of cash inflow minus present value of cash outflow. That will give you NPV. Done. And what is the decision rule? Look at the name, net present value. Net present value. And how do you get that? Present value of cash inflow minus present value of cash outflow. So if NPV is positive, that means from that project you are getting a benefit. Okay, so what's the decision rule? If NPV is greater than or equal to 0, if NPV is greater than or equal to 0, then you will reject the project or accept. Accept. If NPV by chance is negative, then you will reject the project. Because NPV basically is trying to calculate the benefit. If benefit is positive or 0, accept. If benefit is negative, reject. Why 0 also we accepted? Sir, when NPV is 0, are we making any profit? No. Are we making any loss? No. So that means whatever we are recovering, whatever we invested, we recovered. Hence at 0 also you can accept. There's a change. Earlier we used to say at 0, it was company choice, whether they can accept or they can reject. Now they have modified the things in our study material. 0 means decision now is accept. And then sometimes they also ask you decision rules, so do remember that. In fact, I think in one of the RTP or MTP, this certain way they ask decision rule, theory of NPV, profitability index, etc. etc. So this, whatever we have written in box, you need to write in one liner. And done. So any problem with this or pretty straightforward? Straightforward. How do you find present value of cash inflow? How do we find present value at all for that matter? Take the future cash inflows and multiply by the discount factor. If you take the future cash inflows and multiply by the discount factor, you automatically get the present value of cash flows. Done. Outflow will anyway happen at year 0. Outflow anyway will happen at year 0. Year 0 means future or now. So outflow is already on which platform? Present value platform. So outflow ka present value, though we have written in the formula present value of cash outflow, we don't have to find this because outflow is already on present value platform. All we need to express is inflows, you first get it on the present value platform. How do you get that? Take the future cash flow and multiply by the discount factor. That's what I wrote here in cash flow column. If you just check, this is your future cash flow, multiply discount factor and you will get present value of cash inflows. Done now? Okay. That's about this. Next, profit and how do you find discount factor, people? What's the formula? 1 divided by 1 plus I whole power n. I for interest rate, okay, which will be given to you in the question, n for number of years. Okay. And this discount factor is always after tax cost of capital. They will give it to you in the question. Okay. That you just need to take that. Next is PI. PI means profitability index. Another name, present value index. Another name, desirability factor. This is just an extension of NPV. How did you find NPV? Present value of cash inflow minus present value of cash outflow. What you subtracted, here you divide. Because index, no. Index we express as a numerator divide. It's like a ratio. How do you find ratio? numerator upon denominator. So how do you get profitability index? Present value of cash inflow divided by present value of cash outflow. Done now. Now let's say inflow ka present value is 1 lakh, outflow ka present value is 50,000. What are you getting? 2. Right? When you do this, you're going to get 2. So what's the decision rule over here is, if profitability index is greater than or equal to 1, then you can accept the project. If that index is lesser than 1, then reject the project. This is a decision rule based on profitability index. Okay. So this is just a pure extension. Nothing new in this case. Can we move forward to the other one? Yes, people. Next is IRR. IRR you already experts. You know IRR ka full form, internal rate of return. Another way they also sometimes call it as implicit rate of return also. So IRR is basically a rate at which present value of cash inflow will be equal to present value of cash outflow. If inflow ka present value, outflow ka present value, if it is same, means obviously NPV will be 0. That's the reason we say IRR is a rate at which your NPV is 0. And IRR ka interpolation formula same. Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate, whole thing multiplied by higher rate minus lower rate. You assume 2 rates and accordingly do the question. Fine now people. But be careful. Sometimes question only will give you rates. They will give you 5%, 7%, 9% ka discount factor they will only give. If question gives any rates, take that only. You don't assume. When question gives the rate, because no IRR ka answer will keep differing based on the assumption. If you take 10 and 12 and solve, you will get one IRR. If you take 15 and 20, you will get a different IRR. Every student will make same assumption or different assumption. Different assumption you can make and everyone's answers are right. So it will become difficult for the invigilator to find. Hence usually what ICAI does is, for IRR they will only give the rate. They will only give the rate somewhere in some corner of the question. In that case, you cannot assume. You have to take the same rate. If they don't give, you are free to assume whatever rate you want. Otherwise, watch out, take the rate and solve. Otherwise, you will not get marks. Fine, people. And one more thing is decimal. Sir, if the question gives the decimal factor in 3, then you will exactly take how many decimals? 3. If they give 4, you will take 4. If they don't mention anything about decimal, then you are free to take 2 decimals, 3 or 4, your choice. But usually in ICAI ka majority solution, if you just check how many decimals they take, 3 decimals is what ICAI is following as a standard. In some problem they will also take 2 and 4 also, but majorly they take 3. So if you want, you can follow the same for your examination. Done. Can we move on to the next one? Next is MIRR. MIRR means modified internal rate of return. What is this concept is? Now look at this. I've given a small example. If required, if you have understood this particular example, I'll not take up a question. Otherwise, we'll do one question on MIRR. So check. Cash outflow at year 0 assumed how much? 20,000. Discount factor is how much? 10%. Now people, let's say the project ka life is 4 years. Project ka life is 4 years. 4 years may you get this much cash inflows every year. First year how much? 10, then 15, 12 and 20. This is given to you in the question. Done now. But now IRR and all is a non-discounting technique or a discounting technique. So this 10,000 when we will receive? Not now. You will receive. When we write 1 in FM, it means end of first year. When we say 2, it means end of second year. So this 10,000 company will recover at the end of first year. This 15,000 company will recover at the end of second year. That means all these are present value or future value? Future value. But we need present value. How do we get present value? Multiply by the discount factor. Correct? Okay. Now what MIRR is trying to say is, check this. When did you get this 10,000? End of first year. Project will end at first year or it will go till 4th year? Project will go until 4th year. Now what MIRR ka assumption is? Sir, when you get a cash inflow in first year, will anybody keep that money idle or reinvest? Reinvest. If it's a profitable project, then will we keep this money idle or reinvest into project only? Reinvest into project. Now this 10,000, when did we get? End of first year. Project will run up till 4 years. That means this money of 10,000, how many years can we invest? You got it at the end of first year. Project gets over at the end of 4th year. 1 year is already over. Count how many years project remaining. 2 years, second year, third year and fourth year. I mean, this 10,000 we can invest for how many more years? 3 years. That means, will the value really be 10,000 or it will be something else? Sir, if you invest 10,000 rupees for 3 years, will the value be 10 only or it will be more? More. Fine, huh? Okay, so how do we find that? Very simple. How much is your discount factor? 10%. This 10,000 you can invest for how many more years? 3 more years. So that means what will be the value of this 10,000 by the end of 4th year? You will get a return of how much on this 10,000? How much return you will get? 10%. So how many years can you invest? 3 years. If it's confusing, very simple. Suppose you made a fixed deposit in a bank. How much money? 10,000. What is the term? 3 years. Bank is offering how much return? 10%. After 3 years, what will be its value? How will you do that? Take 10,000 and add 10% 3 times. Yes, no? So that means what is the value? 13,300. Do your calculator. 10,000 plus 10% plus 10% plus 10% you do. How much are you getting? 13,300. That will be the value. Any problem? Are we good with this so far? Fine. Like this you can directly get. You can do this directly or you can use that mathematic formula. Remember, currently the value is how much? 10,000. We need that current value or value after 3 years? After 3 years. I mean, this becomes present value. We need value after 3 years means we need future value. How do we get future value? Present value into 1 plus I whole power n. To get present value, we take future value and divide and multiply by discount factor. How do you get discount factor? 1 divided by 1 plus I whole power n. Now, if you know this, can't you find out future value? How do we find future value? Send this to the other side. So it will become what? Present value into 1 plus I whole power n. Yes, no? This, ICA calls it as reinvestment factor. This ICA calls it as reinvestment factor. What is I here? 10%. Now calculate that also if you want. 1 plus I whole power n. I is what here? 10%. So 1 plus 0.1. This 10,000 you can invest for how many years? 3 years. So n becomes what? 3. So 1.1 into 1.1 you press and again press equals to button. You should be able to see 1.331. Getting it out. Now take this and multiply reinvestment factor. You will automatically get the same answer. 13,300. Okay people. That's how ICA presents. They don't use the simple approach. It's very simple, no? Right? But ICA in MIRR question, they will take the cash inflow. They will have one more column called what? Reinvestment factor and then get terminal cash flow. Terminal cash flow means what is the value at the end of the project. Here in my example, project is ending in 4th year. Done now. Can we try both the methods for next one? Check. Now this 15,000, when did we get? End of 2nd year. This 15,000 we got it at the end of 2nd year. Yes, sir, people. Now, how many years can you invest this 15,000 now? You got this at the end of 2 years. 2 years is already over. Project will end at the end of 4th year. So how many years can you invest? 2 more years. So how much will be the value? 15,000 plus 10%. You will add it once or twice. So 15,000 plus 10% plus 10%. How much? 18,150. This is a simple method. ICA method is what? Reinvestment factor. How do you get reinvestment factor? 1 plus I whole power n. I is 10%. N for how many years can you reinvest this money? 2 years. So here n will become 2. 1.1 into 1.1. How much? 1.21. So take 15,000 into 1.21 you do. You'll automatically get 18,150. That's another way. Presentation is your call. Okay, Naji. And now same thing. This 12,000 when did you get? End of 3rd year. So how many years can you reinvest this? 1 more year. That means how much return you will get? 10%. So 12,000 plus 10% you do. How much is that? 13,200. Our reinvestment formula is 1 plus I whole power n. N is here what? 1. So 1.1, that's all it is. And then we can't do it. 1.1. So 12,000 into 1.1 will become how much? 13,200. Last year, 4th year, 20,000. You got this 20,000 at the end of 4th year. And project ends at the end of 4th year. So can you reinvest this or you can't? That means its value will, don't write 0. It's you get this at 20,000 means its value is what? 20,000 only. Done, people. That means all these are value now or at the end of 4th year. At the end of 4th year. Why 4th year? Because in my example, project is ending at 4th year. That we call it as terminal cash flow or simply we can call it as TCF. Done, people. So add all of this. How much is this? 64,650. Done now. Everybody good. Now what MIRR is trying to calculate is, what MIRR, first maybe you tell me, what is IRR trying to calculate? Then I'll tell you MIRR. What is IRR trying to calculate? At what rate? IRR is trying to calculate at what rate present value of cash inflow and present value of cash outflow both are same. At what rate present value of cash inflow and present value of cash outflow will be same, right? What MIRR is trying to calculate is at what rate present value of terminal cash flow will be equal to present value of cash outflow. At what rate present value of terminal cash flow will be equal to present value of cash outflow. That's the distinction between IRR and MIRR. MIRR basically considers one element, that is reinvestment element. Whatever cash inflow you will get every year, nobody will keep it idle. People will reinvest that money. So hence, at what rate terminal cash flow will be equal to present value of cash outflow is what MIRR is trying to calculate. Easy na sirji? Pakka na? Now, IRR, MIRR calculation is same. The only extra fitting you need for MIRR is what, sir? Terminal cash flow. After this step is a ditto. You know this. Tell me, how do you calculate IRR? What are the columns you need? Year, cash flow, discount factor, one rate or two rates. Maybe first we can take it at 10%. Then present value of cash flow. One rate we have to assume or two rates. Okay. Now if you want quickly. Now you don't need to copy this. So. Now year 0. Year 0. Now this terminal cash flow, will get it now or at the end of the project? End of the project. That means end of the project is year 4. How much did you invest to start this project? 20,000. So 20,000 outflow will happen later or now? Inflow or outflow? Outflow. Now this terminal cash flow is an outflow or we will get this? This 64,650 is an outflow or we will get this? Don't forget, all these are cash inflow. We reinvested this and what is its total value? 64,650. So 64,650 is outflow or inflow? Inflow. Yes, sir. At what rate these two will become same? That is what we are trying to calculate. Okay, na? So since we have assumed at 10%, tell me at year 0 discount factor is 1. At 10%, give me 4th year ka PVAF or PVIF. Sir, you will not get 64,650 every year. You will get it once. That to which year? 4th year. That means we have to use PVIF. How do you get PVIF? 1 divided by 1.1, press equals to button 4 times. How much is that? 0.9090, 0.82647513 and 0.6830. Na? 0.6830. That is a 10% you can mug it up. It's okay. It will come in many problems. Okay. 0.6830. Done. And now how do you get present value? Multiply. 20,000 into 1 will be 20,000. These two multiplication how much? Huh? 44,156. So correct. Matching. Now what is your NPV now? What is your NPV? These two if you do, you will get 24,156. Positive. So that means is 10% my MIRR. No. If 10% was MIRR, means this value should have become 0. Is it 0? No. That means we have to do what now? Assume one more discount factor. Number looks a little big. So can I assume maybe 18% and test it out, let's say? Okay, let's assume 18%. At year 0, 18% ka discount factor is 1. For year 0, at any rate, discount factor is already 1 because we are already on present value platform. Now tell me at 18%, 4th year ka discount factor. 1 divided by 1.18 equals to button 4 times. 5158. Now find out the present value of cash flow for me. Take this and multiply by the cash flow. No, this is 20,000 negative and this is what? 33. Oh, that means still we need more. Okay, 1 minute. Hang on then. I think this is a bad example I took. I should have taken a better example. Okay, people, let's try it at maybe 25%. Let's try. Maybe I take 30 better. But you're getting it now. Now on the step is same as IRR. No change. But anyway, since we've started, at least we'll complete. Okay, let's maybe take 30%. 1 divided by 1.3. Press equals to button 4 times. How much is that? 0.3501. Then present value of cash flow. This is 20,000 negative. These two will be ಅಯ್ಯೋ ಸ್ಟಿಲ್ ಅಯ್ಯೋ ಗುರು 40 ಮಚ ಆಯ್ತು 40 ಗುರು 40 changed 40 35 is okay. Now again if you get negative problem noda we'll take 40 da, no issues. 1 divided by 1.4 press equals to button 4 times 2603. Present value of cash flow, how much are you going to get people? Present value of cash flow, this is negative 20,000, this is 16,828. Finally we got a negative number. Okay, how much is that? 3,171. Now plug in your normal IRR formula, which is what? Lower rate. What is the lower rate? 10%. But NPV at lower rate is 24,156 divided by NPV at lower rate minus NPV at higher rate. Higher rate ka NPV is already negative. Negative of negative will become positive into higher rate minus lower rate. 40 minus 10. When you solve, you will get an answer. That is only your MI. Okay, Nachi. This step ditto as IRR. Absolutely no change. The only thing is you need to first find for MIRR terminal cash flow. Consider the reinvestment factor and get the terminal cash flow. You have the answer. You have solved. You're doing taka taka taka. If you solved means tell. 36.5%. Usually it will not be that high and all, but just say fine. Done. So everybody understood MIRR? You want me to take you through one more problem or not required? This is fine. Just walk me through the process again. What is this? MIRR is modified internal rate of return. So here in this problem, what they'll do? They will give you cash inflow. Should we take cash inflow or get first terminal cash flow? Terminal cash flow. How do you get terminal cash flow? Whatever cash inflow you will get, you have to consider the reinvestment. How many years more can you reinvest that? Check. Either you can use reinvestment factor wala ICA approach or simply add the discount factor. By doing all this, totally you will get terminal cash flow. MIRR is basically at what rate present value of cash outflow will be equal to present value of terminal cash flow. At what rate these two will become zero. That only will be MIRR. After this, ditto step as IRR, no change. Okay. MIRR also you are saying it's sorted. I'll move forward then. Okay. Next, discounted payback period. People, we already calculated payback period. What does payback period mean? In how many months or in how many years we will recover our initial investment. Now, one of the drawback of payback period or ARR is they consider time value money or ignore. That particular disadvantage has been sorted out by which method? Discounted payback period. Name itself is saying discounted payback period. Now, for payback period, what did you use? You use present value of cash inflow or just cash inflow? Just cash inflow. And did the payback period calculation? In discounted payback period, will you take cash inflow and calculate payback period or present value of cash inflow? For discounted payback period, take the present value of cash inflow and do the same calculation as you did for payback period. Okay, no? Not cash inflow, but present value of cash inflow. How do you find present value of cash inflow? Take the cash inflow and multiply by the discount factor. You will get the present value of cash inflow. Now you do present value of cash inflow will not be same every year. That means in discounted payback period, you can't use formula. You always have to use what approach? Cumulative approach. Because every year ka discount factor will change, no? So every year ka present value of cash inflow also will change. Hence compulsorily you'll have to do what? Cumulative approach. But any difference after this, any difference between discounted payback period or steps are same? Steps are same. Correct, people? What is that formula we discussed? Lower rate. If payback period is between 6 to 7 years, what you will do? Take the lower rate, which is 6 plus required cash flow divided by actual cash. That is the same. So I don't think so you need any problem for this, no? Manageable, I'm thinking. Same step. Okay, we'll move forward to the next one. Next to a few more aspect and then we are done. Or maybe one more. I think it's anyway, it's there over here. I'll come to that. Capital budgeting under capital rationing. Just a minute. Capital budgeting under capital rationing. These are some special cases. What is this is? Sir, suppose company has 1 lakh money. Company has how much money? 1 lakh money and they want to start a new project. They want to take up some new project. They have finalized 3 projects. Company feels they can take up how many projects? 3. But to take up project A, how much money is required? 50. We have 50 or we have 1 lakh. So that means any fund shortage or we have enough money. For B, how much you need? 40. For C, how much you need? 25. Sir, if you want to do, company now is confused which all project to take. They don't want to take one. They want to take multiple. If possible, everything. Okay. Now, how much money is available with the company? Maximum money available is only 1 lakh. If company wants to take all the 3, how much money is required? Add this. If company wants to take up all the 3, money required is 115. Yes, but is 1,15,000 available with the company or only 1 lakh? 1 lakh. So we can't take up all the 3. Maybe we can take up only 2, right? Now how to choose? How to choose? Now 1 second. They will give you in this problem, they will give you data. Check. A ka investment 50, B ka this will be given. This is the year 0 ka cash outflow. NPV also, let's say they have given in the question. What is A ka NPV? 15,400. B ka assume 18,700. C ka 10,100. Sir, NPV is a benefit. NPV is a benefit. Now you tell me, if there are multiple projects, if there are NPV ka decision rule is, if there is only one project, if NPV is greater than or equal to 0, then accept that project. NPV is lesser than 0 means, meaning if NPV is negative means reject. That's a decision rule for multiple project or single project. Single project. If you have multiple projects, what is the decision rule? Select that project with a lower NPV or higher NPV. Higher or rather highest NPV. Yes, no. Now you check among all these 3, which is the highest NPV? 18,700, which is what? B. And next will be A. Next will be C. Yes, no. Correct. That is right. That is also right. But one thing what this particular special case teaches us is, yes, NPV may be highest for B, but all the projects have same investment or different investment. So what this particular case is, and you don't want to select one project, we want to select multiple, but we have a fund shortage. So we'll have to now decide which all projects should we take. So now what it says is, straight away don't decide based on NPV, because investment is same for everything or different. First, try to get them on one platform for comparison purpose. Now all the outflow is on same platform or different platform. Outflow is different. Hence, what do we do over here is get everything on some single platform. You can get it on 1 rupee platform, 10 rupee platform, 100 rupee platform, your choice. First, get everything on a same platform for comparison purpose. Usually in an examination, we get everything to what platform? 1 rupee investment wala platform. What is this? Is very simple. Now check. How much is A ka investment? 50,000. If you invest 50,000 in A, how much NPV you will get? 15,400. So it's a simple proration. For project A, 50,000 if you invest means how much NPV you will get? 15,400. Now I'm getting everything on 50,000 platform or 1 rupee platform. If 1 rupee is the investment means how much NPV? If 50,000 is investment means NPV is 15,400. If 1 rupee is investment means how much NPV? Calculate X for me. How do you get X here? Cross multiplication. How much is that? 15,400 divided by 50,000. Correct, Aji? So that means what is the formula for this? 15,400 is what? NPV. 50,000 is what? Outflow. That means if you want to express in one line of formula, it will be NPV divided by investment. NPV, or where it went? Here. NPV divided by initial investment. So if you do that, how much did you get? 0.308. Done, people? First try to do this. Okay, if you forget the formula, you can build your formula using this particular cross multiplication. Okay, but simple way is formula. What is that? NPV divided by initial investment. That you calculate for every project. So 15,400 divided by 50,000 is 0.308. Calculate for B also. 18,700 divided by 40,000. How much? 0.47. 10,100 divided by 25,000. How much? 0.4. Correct? Now you tell me, this is the NPV for a different platform or everything on a single platform? Everything we have bought to a common platform. What common is that? 1 rupee investment wala platform. Now what you have to do is you have to assign ranks. You need to assign ranks. Now check. If you invest 1 rupee in project A, if you invest 1 rupee in project A, how much NPV it gives? 30 paisa. Same 1 rupee if you invest in project B, how much NPV it gives? 47 paisa. Same 1 rupee investment if you invest in project C, how much are you going to get? 40 paisa. Now everything is on common platform. For 1 rupee investment, which is giving highest NPV? For 1 rupee investment, which is giving highest NPV? B. So first rank goes to B. For 1 rupee investment, whichever project gives the highest NPV, you assign first rank to that. Done now. Once more, got it? Got it. Next highest NPV is there after 0.47, which is the next highest number. 0.4, that is which project? C. So second rank will be given to C. Last rank will be given to A. That means what is the selection order? First you will select B. If still fund is there, you will select C. If still fund is there, then you will go for A. That's the selection order. Done now. Now let's see. To do B, how much money you need? If budget is 1 lakh, how will you do the selection? First you will select which project? For B you will select. To do B, how much money you need? 40,000. And how much NPV totally B will generate? 18,700. Money exhausted or still it is there? Money is still there. How much money you still have? You still have money. Next you will go for which second rank project is what? C. C requires how much investment? 25. How much total NPV C gives? 10,100. So totally how much money you have utilized? 65. How much you have? You totally have 1 lakh. 65 utilized means balancing figure is how much? Still 35,000 is there. But to do A, how much you need? 50,000. Okay, now the question will use one terminology. Based on that, our next point will vary. In these problems, sometimes they will say projects are divisible. They will say what? Projects are divisible. If they say projects are divisible, what it means is you don't have to do the project fully. You can do it partly also. When the projects are divisible. Now, if they say projects are divisible, I mean, should we reject A or we can accept A? We can accept A, but do we have money to execute project A 100%? No, to do project A, we need totally how much money? 50, but we have 50 or we only have 35? We only have 35. If the question says projects are divisible, A also we will take up, but we will not be able to complete it because we are investing only how much? 35,000. Sorted out. Correct? And now NPV, don't write 15,400. Prabhu. 15,400 NPV you will get provided you invest how much? 50,000. Are you investing 50 now or only 35,000? So you have to do proportionate. 15,400. This number is a NPV. If you invest 50,000, but are you investing 50,000 or only 35? Only 35 if you invest means how much NPV you will get? 10,700. Like that. Done. Any problem? This is a selection rule. Usually in the question they say projects are divisible. If they say projects are not divisible, then A, cut it off. You will only be able to do B and C. That wala combo. Done, people. This scenario is a special case. We call it as what? Capital budgeting under capital rationing. You will apply this. You will do this 1 rupee investment only if the question specifies. Otherwise, no need to do this capital budgeting and under rationing wala case. Only if question specifies. Done, sir. Need a minute to process or carry on? Any problem? Last bench? You want me to zoom in on anything? You're looking at me, I'm looking at you. So what do we do? Yeah, proceed. Done. All right. Next, people. Break at 10:30. Okay, no? I think as informed yesterday. Okay, no? Lunch break, we will see. No lunch break means 2:30, I will leave. With lunch break means 1 hour extension. You decide, and at 1 o'clock, I will ask you once again. That time you tell me how you want to go about it. Okay. For now, let's not worry about that and take too much pressure. Yeah. Now, can we go for next special case? The next special case is, sir, let's say there are 2 projects, or maybe let's take up this only. Where is that? Here. Let's say company has to choose between X and Y. They can't do both. Company wants to select only one. Either X or Y. Both ka initial investment is what? Same. Both ka initial investment is same. NPV here X ka 15, Y ka 19. Okay. That means now if I stop here, what will be the decision rule? You'll select Y or X. Among multiple projects, what is the decision rule? You'll select the project with a lower NPV or higher NPV. This is 15 NPV, this is 19. So obviously the selection will become Y. Correct? But hang on, they'll give you one more data over here. Useful life of X is only 4 years. Y ka is 5 years. So life is same or different? So it's common sense, no? If you run the project for a longer duration, you will get same benefit or higher benefit? Higher benefit. The longer the project is, the benefit will also be on the higher side. So here, taking the decision only based on NPV is correct? No, because is life same or unequal life? So unequal life. So this is a special case where the life is unequal. Here there are a couple of methods, replacement chain model and EAC. Replacement chain model, we will not use it for exam, leave that. There is a technique called what, people? EAC. We will take care of that. We will not decide based on NPV, we will decide based on EAC. What is that? Is very simple, no? Sir, this is this is a total benefit. Do you agree with me? NPV is the benefit on what? For 1 year level or total level? Total project ka, this is the benefit. Okay. But is the life same or different? Different. Hence, what we do over here is get the average benefit. Get the average benefit. Whichever project has the highest average benefit, select that. This is the total benefit, right? But since life is different, first try to get the average benefit of both the project, and whichever project gives the highest average benefit, select that. Done now. Now, how do you find normally average? How do you find average? Total divided by number of years. What is a total NPV? NPV is benefit only, no? What is total benefit? 15 lakh. What is a total life? 4 years. So 15 lakh by 4 you do. You're getting some number. Then 19 lakh divided by 5 you do. You're getting some number. Done now. Is that appropriate way to do it? When you did ARR considered time value money or ignored? Ignored. Hence, there we use simple average. But NPV ignores time value money or considers? Considers. And every year ka discount factor. Sir, if the life of the project is 4 years, means all the 4 year ka discount factor same or different? Different. Means here using simple average is not appropriate. Because each year ka discount factor is different. Everyone okay? So here we can't use simple average. We have to use weighted average. Understood the logic? Correct? Now how to do it? Very simple. You'll have to give weightage based on the discount factor. Now let's say discount factor is 10%. Discount factor is 10%. First give me PVAF. PVAF at what rate? 10%. For this project called life, which is 4 years. Calculate PVAF for me. Present value annuity factor. How do you calculate that? 1 divided by 1.1. Press equals to button 4 times and then press GT button in your calculator. Grand total button. How much is that? 3.1698. Now don't copy the same here, Prabhu. This ka life is how much? 5 years. Now give me PVAF at 10% for 5 years. 1 divided by 1.1. Press equals to button 5 times and GT button. 3.790. Now you tell me, this ignores time value money or this itself is time value money? Considering time value only, you get this number, no? So this becomes your basis number to find out weighted average. Now how do you find that average NPVs? Take the NPV and divide by PVAF. Take the NPV and divide by PVAF. Both the case, you do it for me. How much are you getting? For X, how much are you getting? 15 lakh divided by 3.1698. That's what I've written here. NPV divided by PVAF. 4 lakh 73,216. 19 lakh divided by 3.7907. 5 lakh 1,227. What is this number? This is your average NPV, ignoring time value money. Consider. Now you do the selection based on this. This is the benefit. So you will select the one with a lower average benefit or higher average benefit. Higher. Which is the highest among these two? Plan Y. I mean, therefore, what is the selection rule? Select Y as it has the highest EAC. Done. We can't use simple average because NPV considers time value. Or if you don't want all this logic wala drama, simple one formula. How do you get ESC? NPV divided by PVAF. NPV divided by PVAF. Do that, do the selection rule. That's all as a formula. I think this also we have got all this data, they will give it to you in the question. I don't think so we need any question for this. This example itself is good enough now. We've learned. Now they will put more blade in question. X limited or Y limited or they'll put some 8 to 10 lines they'll put, but the drama is this only. I've only taken numbers and solved. Good enough now. Okay. Story they will put. Correct. Now people, but do keep in mind, don't mug it up. Don't mug it up literally. Because in some problem they will not give NPV. They will not give you NPV. They will only give you cost. They will only give you cost. Right? Both the problem we have done in our regular class. Here now check, I'll take you through one more example. Now again, company has to decide whether to buy machinery A or machinery B. A will cost, A ka running cost is how many years? A ka life is 4 years, B ka 5 years. A you can use it for 4, B you can use it for 5. Life same or different? Unequal life. Now A will cost how much to buy? Present value of cash outflow. A will cost how much? 10 lakh. B will cost how much? 11 lakh. In fact, they will not give you this. And how they will structure this question is, maybe I'll just quickly tell you and then probably do it. People, they will give you in these problems A ka multiple cost and B ka multiple cost. Like what are those multiple costs? Now let's say they will say A ka year 0 cash outflow is let's say 5 lakh. B ka let's say also 5 lakhs. That means A and B is costing different or same amount? Same amount. When if you want to buy an A and B, both will cost, it could be same, it could be different, doesn't matter. Okay, I've just taken same for simplicity. Then they will say running cost per annum. They will say what? Running cost per annum. For A it is 1 lakh, for B it is 1.2 lakh. Possible. Or they will give you different running cost. What is the life of A? 4 years. What is life of B? 5 years. They may give you same running cost every year, or it may be different. Okay, people. Now, how did you calculate ESC previously? Tell me, what is that formula? NPV divided by PVA. To get NPV, we need two data. To calculate NPV, we need two data. What is that? We need cash inflow as well as we need cash outflow. Now, you check this question. Do we have benefit data over here? This is outflow. Running cost means maintenance expenditure. That is an inflow or outflow again. Right? That means in this problem, can you calculate NPV or only cost is given? Cost is given. Right? Now, straight away, don't add and say 6 lakh. Hey, no. No. This is 1 lakh rupees every year. Right? This is a running cost per annum. Right? So, hence, and this 5 lakh rupees you have to incur now. This 1 lakh you'll incur now or every year. Every year. That means this is on which platform? Future value. This is on which platform? Present value. Straight away we can add. No, you need to first find what? Present value of this. You need to first find present value of this. This is already on what platform? Present. So when you find both ka present value, then you will get what, sir? Total present value of cash outflow. That I have assumed it to be 10 and 11 here. Everybody good? This usually will not be given to us. We need to find. Understood, everybody? Everybody good? Is this NPV or outflow only? Outflow. But is inflow ka data given or missing? Missing. That means here you will take the decision not based on benefit. You will take the decision based on cost. Which cost? Total cost or average cost? Average cost. That only again we are calling it as what? EAC. But here EAC is not average benefit. Here EAC is average cost. Now tell me the formula. There the formula was NPV divided by PVAF. Here NPV na present value of cash outflow na. Present value of cash outflow divided by PVA. Done, Sarji? Everybody good? And how much you're getting it as? See, 10 lakh divided by PVA if you do. Here you will get 3 lakh 16,000. These two got division if you do, you will get 2 lakh 90,237. Any problem? Now tell me the decision rule. You will select the one with the highest EAC or the lowest EAC. This is not the benefit side. This is the cost angle. From the cost, if you are making the decision, you will select the one with the lowest average EAC. Which is the lowest number? Machinery B. So therefore, selection rule is this. Done now. So just because it is ESE, don't select the one which is highest. First check, have they given NPV or have they given cost? If it is benefit angle, then you'll select the one with the highest ESE. If you're working from cost angle, you'll select the one with the lowest ESE. That's the thing. Manageable now, people. Work. Next, some decision rule. This came as a theory in your current RTPs. What is a decision rule for individual project as well as multiple project? Now, first people, payback period. Payback period. Payback period meaning is what? In how many months or years we will recover our initial investment. We want this recovery to happen as long as possible or as soon as possible. I mean, if there is a single project, if they have multiple project, means you'll select the project with the highest payback period or the lowest. But if you have a single project, means then you will have that individual cutoff. Like now you will have individual target. No, I want to clear CA in first attempt too. Someone may say I want to clear CA within 3 attempts. So possible. No? Yeah, I hope nobody has that target. Yeah, just saying, right? Same way, company also will have a target in how many months or in how many years they want to recover their initial investment. Now let's say one company, people, they have a rule that they want to recover initial investment within 3 years. Within how many years? 3 years. A particular project ka payback period is 4 years. Now you tell me, this project will be accepted or rejected? What is company ka rule? They want to select that project where initial investment can be recovered within 3 years. This is any data or internal deadline? Company ka internal deadline. How much is that? 3 years. But one particular project ka payback period is how many years? 4 years. So this project will get accepted or rejected? Rejected. Why? It has crossed our internal deadline. That's what I've written over here. If individual project if you are doing a payback period, means that project ka payback period should be lower than expected period. Expected period means deadline. If it is lower than our deadline, accept. If it is equal to our deadline, accept. If it is crossing our deadline, reject. That's your individual project ka payback period. Any problem? No. Now ARR. ARR ka full form, people tell me. Average rate of return. Return. Last word, return. It's a return. Return means cost or benefit. So if you have multiple projects, you will select the project with the lowest ARR or highest ARR. Since ARR is a return, you want to select that project with the highest ARR. If you have only one project, let's say project ka ARR is 12%, accept or reject. You have only one project. Project ka ARR you calculated. How much did you get? 12%. Accept or reject. We need to check. So remember, for individual project payback, we had one internal deadline. Same like that, you need to check one internal expected return. Let's say company, whenever they do a project, they expect minimum 15% return. What is company ka expectation? 15%. From every project, they'll expect how much return? 15%. But this project is giving how much? 12. That means accept or reject? Reject. Why? It is lower than expected. Fine. Suppose ARR is 17%. Then accept. So that's what I've written here. If it's individual project, the return should be higher than expected return. Expected return means our internal deadline. If it is equal to or greater than our internal deadline, accept. If it is lesser than our deadline, reject. NPV decision rule you already know. If you have single project, what is the decision rule? If NPV is greater than or equal to 0, accept. If it is lesser than 0, reject. If you have multiple projects, you will select the one with the lowest NPV or highest. Profitability index also same. What is the decision rule? Individual project profitability index should be greater than or equal to 1. If it is lesser than 1, reject. If you have multiple projects, what is the decision rule? Select the one with the highest profitability index. IRR also same. Sir, IRR again full form is what? Internal rate of return. So if you have multiple projects, you will select the one with the lowest IRR or highest. IRR is also a return. So you'll select the one with highest IRR. But if you have only one project, what is the decision rule is? Now let's say people, IRR of one project is, let's say 15%. IRR of a particular project is 15%. To do this project, company will have to borrow money. Every project needs investment. You can raise that money through equity shares or retained earnings or preference shares or debt. If you have multiple sources, if you have used, means then we calculate what? KO. KO is overall cost of capital. Let's say overall cost of capital is 11%. Now you tell me, rejecta, accepta. What is the decision rule? Rejecta, accepta. Sir, you're doing a particular project where IRR expected to be 15%. But to do that project, how much cost you're incurring? 11%. That means IRR is a return. Return is lesser than cost or return is greater than cost. That means in this case, the decision rule will be accept. If it's other way around, IRR is 15%. Let's say KO is 17%. Then accepta, rejecta. Here it will be reject. Because the benefit you are getting is only 15. It is costing how much? 17. So in that case, it will be a reject wala rule. So that's what I've written over here. If IRR is greater than or equal to KO, then accept. If IRR is lesser than KO, then reject the project. That's your decision rule. Over. Almost over. Moana. Last bit to people, or I'll do a thing. I think this one I'll probably explain with the help of a question only. I think maybe better. We may not understand it. If you have attended my class, I would follow the same steps, so you might get it, but newcomers may not get this. So let's do a thing. Let's do one question and come back to this. Fine. Remind me. I'll come back to this chart and show you once again. Can we have a quick recap? What is the chapter name? Investment decisions. The whole drama of this topic is whether to take up a particular project or not to take up. Okay, and these are not simple decisions because the amount of investment will be very huge and the life of this project also will be very high. So it has an impact for a longer duration. Hence we use a technique called capital budgeting techniques. Under capital budgeting, we have many methods. Broadly, if you have to segregate them, it will be discounting technique, or another name, traditional technique, and another one is rather non-discounting technique or traditional technique. Another one is discounting technique. Under non-discounting technique, we have payback period. Payback period simply means in how many months or in how many years we will recover our initial investment. Payback period is simply given by the formula. You will directly apply formula or check whether annual cash inflow is same or not. If annual cash inflow every year is same, payback period is simply given by the formula initial investment divided by annual cash inflow. You want me to show the chart? You're looking at it. Okay. This is the payback period formula. If annual cash inflow is fluctuating every year, then we find cumulative method. Cumulative means every year ka cash flow go on adding and then apply the formula. If payback period is between year 5 to year 6, we'll start with a lower number, which is 5 plus required cash flow divided by actual cash flow. Then payback reciprocal. How do you calculate payback reciprocal? 1 divided by payback period. Okay, next is ARR. Average rate of return, accounting rate of return, or book value rate of return. ARR is simply given by the formula average PAT divided by initial investment, or average PAT divided by average investment. How do you find average profit? Add all the years ka profit divided by number of years. If they don't give you profit, if they give cash inflow data and cash outflow data, can you find average PAT? Yeah. Total of all the cash inflows. Total of cash, total add all the years ka cash inflow. Deduct all the years ka cash outflow. Outflow will only happen at year 0. So inflow you will treat it as an income. Outflow you will treat it as an expense. From total income, if you reduce total expense, you will get total profit. We don't need total profit. We need average profit. So hence what do you do? Divided by n you'll have to do, number of years. That way you'll get average profit. And how do you get average investment? Half of initial investment minus salvage value, close the bracket, add salvage value, add WC, working capital. This will not be there, so it's fine. Okay, next we looked at discounting techniques. First one is NPV. NPV, how do you get? Present value of cash inflow minus present value of cash outflow. Now, decision rule. If NPV is greater than or equal to 0 for individual project, except for multiple projects, whichever project has the highest NPV, select that. Then profitability index. How do you get profitability index? Present value of cash inflow divided by present value of cash outflow. Decision rule for individual project is profitability index should be greater than or equal to 1. Lesser than 1, reject. If you have multiple projects, you will select that project with the highest profitability index. Then IRR. IRR is simply a rate at which present value of cash inflow and present value of cash outflow will be same. Or IRR is a rate at which NPV will become 0. Simply got by interpolation formula, lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate, whole thing multiplied by higher rate minus lower rate. Assume two discount factors and do. Before assumption, check the question. If question has given any rates. If they have given, take the same. Then MIRR. MIRR ka full form is Modified Internal Rate of Return. MIRR is trying to test at what rate present value of terminal cash inflow, at what rate present value of terminal cash inflow will be equal to present value of cash outflow. Here simply what we have to do, whatever cash inflow we have, we'll reinvest and get everything to which platform? Terminal cash flow wala platform. In this problem we got total terminal cash flow 64,750. How much was outflow? 20,000. At what rate these two will be equal? That only we call it as MIR. That wala steps is same. Assume two discount factors and use the interpolation formula. Okay, next two we looked at capital budgeting under capital rationing. This is a scenario where we have limited money, but we have to select multiple projects. And all the outflow of all the projects same or different? Different. So first get everything on 1 rupee platform. So how do you get this? NPV divided by initial investment. NPV divided by initial investment, if you do, you will get NPV for 1 rupee platform. Then assign the ranks and accordingly do the selection. And check if the project is divisible or not. If it is divisible means part of the project is also acceptable. If it is not divisible means either you have to accept full or reject full. Beach mein part things not acceptable. Next two. Initial investment same, but project ka life is same or different. If life is different means we have to use which technique? EAC technique. But before you apply EAC, check have they given you only cost data or have they given you NPV data. So first of all, how do you find out EAC? If they give you NPV. If they give you NPV, how do you find? EAC means what? Average. If you are working from NPV angle, when you find EAC, that is average NPV. How do you get that? NPV divided by PVAF, right? And what will be the decision rule here? Since NPV here is given, this EAC will become benefit. You will select the project with the highest EAC, lowest what one? You will select the project with the highest EAC. But suppose if they give you a data of only cost, benefit data not given, they have given you only cost, right? So first find what? Average EAC. How do you get that? Instead of NPV, we will take present value of cash outflow alone in the numerator divided by PVAF. That way you will get your EAC. This EAC is your average cost. Now you will select the project which has the lowest EAC. That's your decision rule. Okay. That's pretty much it. I think decision rule we already touched upon, so it's okay. On this part, remind me after the problem if it doesn't get covered. Once again, I'll show it to you. Now, can we go through a few questions on whatever we have studied? And now your choice. So first one is this. This is MIRR. You need one more problem on MIRR or not required? You came late, Noda? He's like, I came late. Tell me once again. You watch a recording, macha. We'll publish anyway in YouTube anyway. Others are okay, no? Others who are covered. We need one more question or wastage of time? Because I want to focus on things. Comfortable, no? Manageable. Others are study material question only. So basically, what is MIRR ka platform? Or just tell me one thing. How much investment you are making here? 136. What is this? Year 0 ka outflow. Now here they have given you cash inflow for 1 year or 5 years. Now you tell me this 30,000 when you will get? First year. So this 30,000 you can invest for how many years? 4 years. At what rate? They have given how much rate? 8%. First year ka alone you calculate. Let's see. What is terminal cash flow for 30,000? 30,000 plus 8%. How many times will you add? 4 times you will add. How much you going to get? 40,800. Like everyone got same number. Pakka no? Like this, each amount you go on reinvesting and you will get the total terminal cash flow. Okay, people. Now what you have to do? You are checking. Okay, fine. Done now. At what rate? What is your outflow? 1,36,000. What is your terminal cash flow ka total? 2 lakh. At what rate these two becomes equal? That only is your MIR. Now assume 2 rates and do the things. I think here I have assumed 8 and 11 and done the answer. Fine now people. So MIR finally you get the answer as 9.36 over here. If you assume different rate, will the answer be same or it will change? Based on your assumption, answer will change. Okay na? I have given the answer at 8 and 11. That's all over here. Overall satisfied with MIR? Manageable at least. Okay, can we move on? We'll move on then. This one. Remember ARR? Now check for ARR, we need cash flow or we need PAT? PAT. Now in this problem, we need to calculate ARR. There's only payback period and all is faltu. 1 minute, hang on. I'll just first check the number of questions I have. Okay. All right. 8:30. Because after 10 o'clock, you look at me weirdly, no? So, now, or I'll just tell you, sir, payback period. Payback period, you need any questions are manageable. If you check project A ka, every year ka, they have given cash inflow, okay? All these are. Is it different every year or the same every year? So, payback period, you can use formula. What formula? Initial investment divided by annual cash inflow. 5,000 divided by 900. That only is payback period. But for project B, is every year ka cash inflow same or different? That means we have to use formula or cumulative approach. Cumulative approach. Same goes for C also. So payback period is easy. NPV, I think if I do it, it will be an insult to your caliber. Yes, no, he's saying yes only, correct. So cost of capital, how much? 10%. Oh, sir, people, this is outflow, this is inflow. But all these inflows are on present value platform or future value. How do you get them on present value platform? Multiply by them, discount factor. Pretty easy again. NPV I don't have to go for. ARR is what I had to discuss once. So for ARR, we don't need cash flows. We need PAT. PAT given a missing. So now you calculate. Let's see for 2 minutes. How do you calculate? We did explain this. For A, all of you calculate for A. Cash inflow they have given for 10 years. Every year 900. Cash outflows at year 0, 5,000. How do you calculate the average PAT? All of you calculate average PAT. Let's see. If you're getting 400, right answer. Otherwise, no. You're getting 400, paka. How did you calculate? If they don't give PAT, what is the shortcut way? Take first the total cash inflow. How many years given? 10 years. Every year, how much is cash inflow? 900. 900 into 10 is how much? 9,000. So total cash inflow is 9,000. This is like your income. Minus cash outflow you do. What is cash outflow? 5,000. So this is like your expense. Total income minus total expense will give you total profit. We don't need total profit. We need average profit. How many years are there? 10 years. So do this, you will get 4. That's all. Clear? Same thing we'll have to do it for project B also, project C also. Clear? Now I don't have to spend time on that. Here it's given. Done. Or maybe for project A, you calculate of ARR for me. Let's see. Project A ka. Project A ka ARR we calculate. What is the average PAT we got? 400. So don't do it under initial investment. I know that is easy. Okay, average ARR ka one formula is average PAT divided by initial investment. How much is initial investment? 5,000. So if you do initial investment, or maybe both, we will put it up here. What is ARR, people? One way is average PAT divided by initial investment. Average PAT is 400. Initial investment for project A is 5,000. How much is this? We want a return. Return is usually we express in percentage. So multiply by 100. 8%. That is using what? Initial investment. Let's calculate using average investment. So calculate. First, how do you get average investment? What is the formula? Half of initial investment minus salvage value plus working capital. Here salvage value not given. What is initial investment? 5,000. Salvage value working capital not given. So effectively you have to do half of initial investment. That's all it is. How much is that? 2,500. Everybody got it now. Only initial investment is given. Salvage value and all not given. So half of 5,000 minus 0, close the bracket, plus salvage value 0, plus working capital also 0. So in average investment, how much are you going to get? 2,500. Average PAT is 400. Average investment is 2,500. So 400 divided by 2,500 into 100. How much are you getting, pa? You are getting 16%. Okay, sir. That's all. Same thing you'll have to do it for B as well as C. These problems are easy, but it can be a little lengthy. They will give for 8 marks. The crux here is not to just solve them, to solve them within 15 to 20 minutes tops. Okay. That's the average. So like if it comes for 10 marker, people roughly for one marks, you need to take 1.8 minutes considering the time we have. So for 10 marks, roughly you have to take 18. If you want, you can stretch up till 20 to 25. Beyond that, though, definitely danger zone. Okay. If you feel you have crossed that, leave the question wherever you are. Leave 1 or 2 pages blank. Move forward to the next question. Don't, because people, one thing again and again we keep telling, oh, but you guys will probably face this difficulty in life. No, if you don't know things, very easy. I don't know. Move on. Very simple. Yes, no. But I know the answer to this question. I know each and everything, each comma, each full stop I know. But time is up. Another 5 minutes only I will complete. Just I will take 5 more minutes and I will complete. When that 5 minutes will become 30 minutes, you will not know. So if the time has hit means move on. Right? Than getting 10 on 10 in one question, it is very important to get 50 on 100. Our goal is to get 50 on 100, not 10 on 10 on one question. Keep the higher goal always, right? Completing the paper will increase your chance of clearing the exam, not scoring out in one question. So if time has hit, move on simply. I know it's very difficult, but you need to have that heart from inter-level onwards. I know many of you will face time shortage because paper will be lengthy. At least 2 papers at overall in 6 papers, 2 thought definitely will be lengthy. It is not a mystery. From the time we are writing, everybody is saying the same story. After exam, even we also used to say the same thing. I know, just needed another 20 minutes extra. I could not complete the paper. I only completed for 70 marks, 80 marks, 90 marks. This is the common dialogue CA students give. Okay. So I'm sure many of you will give the same dialogues after exam. But don't worry, it's fine. I've seen people attempting for like 80 and getting 70, 75. Fine. So don't be disheartened. If you write properly, you will get marks. So first focus that, use that 15 minutes very carefully. Read and figure out what order. It's not mandatory to write that first question first only. You can answer in any order. First, you decide your strength, which question you're completely comfortable. Make an order of that and start solving. And first question only, you should be like, you literally think that you're on fire. Daga. You should keep doing like this, full fire. Okay, keep jumping on the chair. Watch out, people. Time to definitely don't ignore. Keep watching every 15 minutes. Make it a point once to see where you're leading, how much you have completed. Make sure at least 80 to 90. That much, so at least you should be able to complete the paper. Lesser than that, quite difficult. Because then we will start freaking out and start writing our own FMO in examination paper. So yeah, so let us not get into that particular mode. So manage the time carefully. This is very important. That you can know only by writing mock papers. 1 or 2 mock papers, if you know, roughly you will know how much time you are taking. Accordingly, you can improve. And don't worry too much about handwriting. As long as we say, no, whatever you are writing, your neighbor should be able to understand. If that is happening, that is sufficient. That much legibility, that much neatness is sufficient. It need not have to be gundu types. You're right. That's enough. Let it not be doctor handwriting also. It should be just visible or legible to your neighbor. As long as, because invigilators also understand. Even they are also CAs, no. They also know how they wrote. So that way and all, they'll put in efforts to at least try to understand what you have written. Because people will sympathize with you. Don't worry about that. Yeah. So yes, but do make sure that you improve your writing speed consciously as much as possible. Now this question, Damar then. Damar. Next. EAC you already know, no people. Again, I think I don't have to waste time on EAC wala. But remember, EAC can be on cost angle or on the benefit angle. So that you just watch out to. Then no. On this one, maybe I'll take up. Yeah. This, yeah, it's a good question. It's a usually full-fledged question expected for somewhere between 8 to 10 marks in examination. These types, I mean, not exactly same. If exactly same comes, means I will be full praise to the sky only. Yeah, but it has, you never know. Whichever, every question in study material has come once in exam or the other. Okay, my blessing, my hope is that this question only comes in this attempt. Okay, thank you. I know. If it doesn't come, don't curse much. Okay. All right. Can we move on to the next question? It's a study material question only. If you don't have the question, it's fine. Just listen. HMR is considering replacing a manually operated old machinery with fully automated new machinery. This we call it as replacement decision. Old one you are replacing with new one. Okay, people. Now I told you. What much? Whenever they give you replacement decisions, page number, page number I don't know. He found it. Awesome, macha. Okay, so it's a study material question only. I'm pretty sure. Now, in replacement decisions, no people, they will give you old machinery ka data and they'll also give you new machinery ka data. One way to do this problem is first to find old machinery ka NPV, then find new machinery ka NPV. That means you are solving the question once or twice? Twice. Then you do the selection. Whichever machinery has highest NPV, select that. That is one approach. But our ICA does not follow that. What we follow or ICA follows is incremental approach. They follow what, sir? Incremental approach. My suggestion to you is, since suggested answer will be on incremental approach, if you do under total approach, what I said now, finding NPV of A separately, B separately, that is total approach. Only your decision will match, right? But suggested answers will be on which approach? Incremental, right? Both are right only. But if they are an FM teacher, they should understand that both are right. Marks should be given. But the people correcting your paper is a CA, but he is not a FM teacher. So your answer, they will compare it with suggested answer. None of them matching. Only decision is matching. 0. Can happen. So as much as possible, let's sync up with ICA. ICA is using what? Incremental approach. So here also we will use what approach? Incremental approach. So what is the incremental, sir? You are making us mental. Oh? Very simple. Incremental means extra. Incremental means extra NPV. Ashte. How do you find NPV? For finding NPV, we need cash flow. Cash flow given us, sales given us. So first from sales, we have to arrive cash flow. Walk me through that process. From sales, you reduce all your expenses. They will give you 101 expenses, material, labor, dress, post, doesn't matter. From sales, you reduce all the expense. You will get what? Profit before tax. Reduce tax. You will get profit after tax. Correct? Add back 5 adjustment. First adjustment, depreciation. Then OVAS. OVAS. O for opportunity cost. W, working capital. A for additional capital. S for salary. Yes, sir. Correct. Right? That approach will work for almost every question. Except this question. Or except these type of questions. Why, sir? I'll tell you, sir. Now, people, first I'll tell you the incremental. Incremental approach means we don't want total sales. We want extra sales. Everything on a extra basis. Check here. What is old machinery ka sale? 810. New machinery ka sales? 810. That means how much is extra? Nil. Old ka material cost? 180. New ka? 126. That means you have to find everything on what basis? Extra basis. Don't take the full number. Take only the extra number. That means you will get total cash flow or extra cash flow. Take the extra cash flow and work out NPV. You will get the extra NPV. If that extra NPV is positive, new machinery accept. Otherwise, reject. That's the rule. So everything here on an extra basis. Clear, Asarji? Okay, Asarji? Now, yes, whatever we just now discussed cash flow. That is, yes, that's a template which will work for every question. No? But here also it will work. But before that, you need to put some working notes here. What is that? I'll tell you once we do read the questions. 1 or 2 extra working notes here is required. When they are required also, I will tell you. First, let's read the question. But everyone understood now? So what approach are we doing? Incremental. Incremental approach you will only do when they give you old ka data and new asset ka data. Only that case, if they give you 2 assets ka data, only in such problems you will go for incremental approach. Otherwise, in all other problem, normal approach. So incremental simply means working out the extra. Everything, every income, every expense, every cash flow has to be on extra basis. Now, let's read the data. Old machinery, they want to replace with new machinery. Fair enough. Old machinery has been fully depreciated for tax purpose. Old machinery has been fully depreciated for tax purpose. That means as per tax, can you claim any more depreciation on this or fully depreciated? First of all, people, when we worked out cash flow problem, right? From sales, you said reduce all expense. That expense will exclude depre or include depre also. Even depreciation you need to reduce. Why? Because depreciation is also an expense, and due to expense your profit will reduce and your tax also will reduce. That means, can I say on depreciation you get tax benefit? Because due to depreciation is an expense. Due to an expense, profit is reducing. If profit reduces, tax also will reduce, right? So on all your expenses, including depreciation, you get one benefit called what? Tax benefit. To calculate tax benefit, first we reduce depreciation. But is depreciation a cash outflow item or non-cash item? Hence, after paying tax in one of the adjustment, we add back depreciation. That's the logic of adding back later. Now here, check in this problem. On old machinery, can you claim any more depreciation or fully depreciated? It's fully depreciation. So any more tax benefit you will get on old asset or it's fully depreciated? That's a crux. But it has how much book value? 2,40,000. Sir, if it is fully depreciated means it should be zero, no? But they said book value how much? 240. Weird question, no? No. What they've given is right only. Sir, book value means in your accounts. Book value means accounts. In accounts, we have studied Accounting Standard 10. Talks about property, plant and equipment or fixed asset. In your accounts or in your Accounting Standard 10, there is no depreciation rate concept. What Accounting Standard 10 says is you depreciate the asset based on pattern of economic benefits. Or leave that. Now, in accounts, basically there is no depre rate. There is no depreciation rate. But same thing if you compare in Income Tax Act, for every asset they have suggested income tax rate. So in income tax there is a depreciation rate for each asset. For in accounts there is no depre rate. That means, do you think accounts ka depre and tax ka depre will match or mismatch? Therefore, accounts ka book value and tax ka book value also will not match. There will be a mismatch. Clear, sir? In this book value, what they have given, no, it's not as per tax, it is as per accounts. But as per tax record, the same book value is 0. Why? It is fully depreciated. Done now. Now, the first question that will come in your mind. People, I am neither in accounts, nor I am in tax. I am in FM. We are in FM. Now, we should consider accounts ka data, tax ka data for FM subject. We should take, because accounts ka book value 240, tax ka book value 0. Which one should we consider for our FM? Very simple, no? FM is a decision making, right? We take the decision making for decision making purpose. We need cash flow. We add back, we deduct depreciation initially because we get the tax benefit. The overall aspect of considering depreciation FM is because of the tax benefit. It is because of the tax benefit. Now you tell me, for our FM, accounts ka depreciation is relevant or tax ka? Because we, for our decision making, we are considering, though depreciation is non-cash expense, we are considering only because of the tax benefit. That means the number relevant to us is not accounts, the number relevant to us is the tax. Dana? That's a synopsis. We don't worry what is the book value as per accounts. We don't worry what is the depreciation as per accounts. We want what? What is book value as per tax? What is depreciation as per tax? Depreciation as per tax on old asset, we already know. How much is that? 0, because it is fully depreciated. If it is fully depreciated, book value as per tax is also 0. So this number, relevant or goli? This is full goli, irrelevant information for our decision. Got it? Pakka na? Yes, sir. The machine has been begun some causing problems. So it cannot fetch more than 30,000 if sold in the market at present. Immediately, if you sell old asset, how much money you will get? 30,000. It will have no realizable value after 10 years. If you still be like, we are Indian, so we will still ujafaye, we will still continue for how many more years? So 10 years, then you will get anything after 10 years or 0. Now only if you sell, you will get 30. If you still persist or continue with this asset after 10 years, value is 0. The company has been offered 1 lakh for the old machine as a trade-in on the new machinery, which has a price of 4.5 lakh. Good deal, no? Now people, if you replace old asset with a new asset, how much will new asset cost? 4.5. It's an exchange system. The vendor is saying from whom we are buying the asset. He's saying old machinery, I will not value it at 30. I will value it at 1 lakh. What is new car cost? 450. That means should we pay 4,50,000 to this vendor or 3.5? In 4.5, 1 lakh he will adjust towards old asset. And we have to pay him balance 3.5 lakh. Are we comfortable? That means you tell me, will we sell in the market at 30 or we will exchange with vendor only? In market, we are only getting 30, but this vendor is ready to offer 1 lakh. So obviously, if we are in the same mind, we will obviously go with the vendor only. Now, life of the new machinery is how much? 10 years. How much is salvage value? 35,000. Fine. Further, check this. This is the main culprit. Always in bigger problems, check the depreciation method. Check the depreciation method. Company follows what method? Straight line method. But for tax purpose, WDV method is followed. So when they say straight line method, what do they mean? Where? In accounts. In accounts, maybe we are following what method? Straight line. But for tax purpose, we have to follow WDV method. And in tax, each asset will have a rate of depre. How much is rate of depre? 7.5%. Now you tell me, is straight line method the relevant data for us or WDV method? We always have to consider accounts ka data or tax ka data. As far as depreciation is concerned, we want only tax ka data. I mean, straight line method is not relevant to us. What is relevant? WDV method. And what is the depreciation rate? 7.5%. This is the only machinery in the block of asset. Okay. Below is the sales and cost from both the asset they have given. Now, one I'll quickly tell you. Now, people, this particular depreciation method is relevant for our FMK decision making. What is that is? Maybe if you want 2 minutes quickly, I'll write. If SLM method is followed, no. If I'm talking all about this in where? Tax. As per tax, if you follow SLM method, then tax record says you will calculate depreciation on individual asset basis. On what basis? Individual asset basis. Meaning each asset ka depreciation is calculated separately, provided you follow what method? SLM method. If you follow by chance WDV method, depreciation is not calculated on individual basis. It is calculated on something called block basis. You must have studied this in your tax ka. If you follow WDV method means, then depreciation is always on a block. Block means it is not individual. Block means group of assets. Block means group of assets. So you charge depreciation based on the group level, not individual level. For which method? WDV method. Is this clear? That means approach is same or different? Different. Now here you tell me, are we following straight line or WDV now? WDV method. Yes, sir, people. Now how to calculate this? I told you the logic of all this. Now I'll not go too much of logic. I'll discuss the format with you. Even if you don't know the logic, if you just follow that format, it will work for exams. Because not much time. That is the reason. We had spent in fact half an hour to 1 hour only on this with various examples. So now so much time not there. Even if I do it, pointless. We'll focus more on the pointer. Now, first everybody got that in WDV method we calculate depreciation on what basis? Individual or block basis? Block basis. Block means one asset or group of assets. Like if just to maybe tell you one more. Suppose we have two plant and machinery. Plant and machinery 1 and plant and machinery 2. This becomes block number 1. This becomes block number 1. Block means a group of assets which are similar. If you have 10 assets, if you have 10 machineries, if all are similar, then all put together becomes one block. Okay, Naji. Now let's say you have land and building. Is land and building and machinery same asset, same nature or different asset? So if you have a land and building, that becomes block number 2. Like that. Block means a group of assets which have similar characteristics. Clear? That's a simple meaning. Okay. Now, what we have to do over here is before you start the problem, normally in these problems we need cash flows. Before you do the cash flows, whenever they say depreciation method, what you have to do is first working notice you'll have to put up is first find out depreciation base of the old asset. What did I say? I'm discussing a format. It will work in every question. But which? What is the test you will do first? This format, what I'm discussing is only for block method. Block method means WDV method and only under incremental approach. If you want to apply this format blindly as a mug up, first you'll ask yourself two questions. What is it? whether it is incremental approach problem I'm solving and is depreciation charged under WDV method. If it is so, whatever format I'm discussing will hold. Okay, na sir ji? And now, first step, what did I say, sir? Calculating depreciation base. Depreciation base means on what value are you calculating depreciation? On what value are we calculating depreciation? First, you calculate depreciation based on old asset, on the existing asset. Sir, this is very easy for me. Zero. Zero. Agree? Why? Sir, existing asset has been fully depreciated as per tax purpose. Depreciation basis means simply WDV. Simply book value. What is book value as per our tax? As per accounts, it is 240 or something they told. But tax may it is fully depreciated means book value is what? Sir, if book value is zero means what will be your on book value only you charge depreciation, no? Right? That book value only we call it as what? Depreciation base. So what is the depreciation base for existing asset? Zero. Why? Because it is fully depreciated. Any problem? Once more. We'll maybe go little slow over here. You're looking at me a little weirdly. So we'll go a little slow. Done now. In exam, in regular class, may 4-5 problems we have done on the same format. Yeah. But okay, I do understand that you might have forgotten or some new students are there. So it is okay. This sorted out. Now people, incremental approach, don't forget. Incremental means old you have to compare with new and get the extra. Now you tell me I need a depreciation base or I need incremental depreciation base. How do I get incremental depreciation base? For that, existing machinery ka depreciation base, I have to compare it with new machinery ka depreciation base. Only then I will get incremental. Yes, no? So what is working note number 2 then? If first working note was to find out existing machinery ka depre base, second will be new machinery ka depreciation base. Okay, na ji? This is very, very simple. I told in tax, depreciation works on a block basis. Correct? Huh? Now, old asset ka block value is how much? Zero. Correct? Huh? Old asset ka block value is zero. Why zero? Fully depreciated. Now I'm calculating old asset ka or depreciation base of new machinery. Depreciation base of new machinery. How you get it is very simple. No? Now people, you have old asset. It has been fully depreciated. If you buy the new asset, one more asset will come to the block. That means block value will be same or block value will increase. So that means you can tell me the formula. What is that? Depreciation base of new machinery. If you want to get it in formula, first take depreciation base of the old machinery. What is old machinery ka WDV? Zero. Now you bought a new asset. If you buy new asset, block ka value will be same or block value will increase? Block value will increase. How much did you buy the new machinery for? 4.5 lakh. Take your calculator. What was old machinery ka depre base? Or rather old machinery ka book value? Zero. You added new machinery for how much value? 4.5 lakh. Yes, sir. So that means simply what I'm saying, when you buy an asset, block value will increase. At the same time, opposite sentence is also true. What is our opposite sentence? When you sell an asset, block value will reduce. Sir, if you buy an old asset, if you buy a new asset means old one you will keep it or sell it. So new ka asset value if you are adding means old ka sale value we have to add a minus. So hence what is that formula? Tell me in formula now if you want. To get depreciation base of new machinery, what you will do? First take WDV of the existing machinery. Add a new asset ka value. Deduct the sale value of the old asset. Sir, old asset ka sale value you will take 30. Old asset ka, where it went? Old asset ka sale value you will take 30. Now 30 you will get if you sell in the market. Are we selling to the market or this vendor? Vendor is offering how much? 1 lakh. So we have to minus how much? 1 lakh. So how much did you get? 3,50,000. That means as per tax, now you will depreciate on how much value? 3,50,000. That becomes your depreciation base of the new asset. Old asset ka how much was it? 0. New asset ka how much is it? 350. Compared to the old, is your depreciation base more? Old was 0, new is 350. How much extra? 350. That only becomes what? Incremental depreciation base. This you need to find out. Done na sirji? Pakka na sirji? Everything on incremental basis. Don't worry about. Don't forget that. Now you tell me depreciation base means what? On what we will charge depreciation. Right? So on this incremental depreciation base, if you calculate depreciation, Will you get depreciation or will you get incremental depreciation? Since this is incremental depre base, on this if you calculate depreciation, you will get incremental depreciation, and that's what we want. That's what we want. Now calculate the depreciation in the normal way. But one pain point is, if it is straight line method, every year depre would have been same. Now here, which method depre? WDV. And what is the life? 10 years. That means now you need to calculate the depreciation for each year separately. Difficult or easy? Easy but lengthy. So what is a maybe 1 or 2 years we'll quickly do. How much is incremental depreciation base? 3,50,000. Simple column. We'll have opening balance, depreciation and closing balance. So how much is the incremental depreciation base? 3,50,000. What is the rate of depreciation as per WDV given in the question? 7.5%. Calculate 1 or 2 quickly for yourself. 350 ka 7.5%. 3,50,000 ka 7.5%. 26,250. From opening balance, if you reduce depreciation, what are you going to get? Closing balance. So these two ka minus this particular value. Correct? First year ka closing will become second year ka opening. Then on this value, calculate 7.5%. You will get depreciation. That's how WDV method works, right? On the opening balance, go on calculating depreciation. And then you will get the closing. Second year ka closing will become third year ka opening. Like this, how many years? 10 years you need to calculate. Done na, Sarji? Any problem? This is the highlight of this question. After this, very, very simple question. Maybe one more working note. After that, straightforward. Got it? First, maybe give me a quick walkthrough of this question. We are doing all this. This working note, this working note, this working note is only required not for straight line method, only for WDV method. Because only in WDV method, we calculate depreciation on block basis. In straight line method, asset to asset depreciation. So you don't need all this working note. Straight away, you can calculate depreciation normal way and compare. And straight line method, depre will be same every year also. So it will be one liner working note. Okay. Only under WDV all this drama. So what drama? First drama is what? Since it is old versus new, we need everything on an incremental basis. So basically we need incremental depreciation. But for that, first we need to calculate incremental depreciation base. To calculate incremental depreciation base, we need two things. What are those? Existing depre base and new asset ka depre base. What is existing depre base? 0. Why? Asset is fully depreciated. If you buy a new asset, then what will be the depreciation base? A simple formula if you want to calculate. How is that? Calculate the existing WDV. Add the purchase cost. Reduce the sale value. That's a format. You will get what? Depreciation base of the new asset if you buy it. Old ka is 0, new ka is 350. If you compare these two, how much is extra? 350 extra. On this extra depreciation base, if you calculate depreciation, you will automatically get what? Incremental depreciation base. 1 year or 10 years? 10 years. That's what we have done till here. Clear, Sarji? Pakka na, Sarji? Move on to the next. Okay. Next one is, now people in this question, did they give you cash flow or they give you income expense data? Income expense data. Fine. Now they're given for old also, they've given for new also. We need old and new, or we need incremental? Incremental. One approach is, but one good thing over here is, have they given it for each year separately or common? That means indirectly they're telling all this value will change every year or same every year? Same every year. Only one data is changing every year, which is what? Depreciation. Rest all income, rest all expense are same every year. Okay, na, sir? So like depreciation, should we have 10 columns here or not required? Not required, because every year data is any which way? Same. Now one way to do it is, everybody, if you want check, from sales, if you reduce all the expense, you will get what? Profit before tax. But before you do that, or maybe if you are smart enough, I think I'll go with this only. Check. Sir, I can't take this data. They have given PBT. They have only given PBT. I can't use this PBT. Why? Main culprit is depreciation. Why? Sir, they gave old asset ka depre 24, new asset ka depre 41. New asset I will not bother. Old asset they have given 24. No, that is pricking me. Why? Why? Sir, old asset ka, it's fully depreciated. Old asset, they clearly told it is fully depreciated. That means depreciation should be 0. Here they gave 24. I mean, this is not depreciation as per tax. This is as per accounts. This is as per accounts. I don't need depreciation as per accounts. I need depreciation as per tax. Hence, what we will do is ignore this data. Ignore this data, because will we take this depreciation or the one we calculated? One we calculated. So leave that. From here, take your calculator. This is your income. From here, you reduce all this expense. What are you getting? From 8,10,000, reduce the circled numbers. You will get earnings before depreciation. Is my statement right? How much are you getting? 3,48,750. That is one approach. Or I'll tell you another shortcut. They've got profit before tax. They reduced the depreciation and got profit before tax. No. This depreciation we can consider or we need to ignore. But they've already reduced. So only add these two numbers. Only add these two numbers. What are you getting? Same 3,48,750. Which is better? From here to here is better or these two is better? These two is better. So we will use this for example. Okay now. So what is earnings before depreciation every year? Simply take this number, add back depreciation. How much is it for the old asset? 3,48,750. Similarly, do the same thing for new machinery. These two data you add. 1 minute. I'll note that down. 4,28,750. Here it is 3,48,750. Correct, people? What is this? This is earnings after depre or before depre? We can't take this depreciation once again. Why? We can't take this. We can't take this depreciation. Why? Because this is depreciation as per accounts. How did we conclude? As per tax, old machinery is fully depreciated. I mean, this value should have been 0. So hence, this is not tax ka depre, it is accounts ka depre. Now you tell me, I need this value, or I need incremental earnings. How do I get incremental earnings? Old is giving 348, new is giving 428. So is NIV giving extra now? How much extra? 80,000. Check the solution. That's what I've done here. That is the next thing. What is the that's the next working note. Earnings before depreciation. Have I had 10 columns or only one column? Why? Because every year ka data changing or same? Same. Hence we have done common. First, profit, whatever they have given, I took, added back depreciation. That's so new old asset you only told 348, new it is 428. Comparing these two, how much is extra? 80,000. What is this, sir? Cash flow na? No. This is earnings before depreciation. So right now we have reached at one zone. What is that zone? Earnings before depreciation. Any problem? And now your format will come into picture. Fine. Now, don't start from sales now. We have to start from sales or we have got earnings before depreciation. Earnings before depreciation. But the main culprit is depreciation same every year or changing every year? That means every year ka cash flow will be same or different. So we need to have one column or 10 columns. The main culprit again is this double fellow, depreciation, because changing every year. So next format check everybody. I did not have one column. I had how many column? 10 column. We will not start from sales. We already worked out. So far what did we got? Incremental earnings before depreciation. How much was that? Different every year or same every year? 80,000. Give the working note reference. Working note number 3 or something, this we got it. Done now. We want earnings before depreciation or we need cash flow? Cash flow. Now people tell me, how do you get cash flow? First you have to reduce all the expenses. Then get profit before tax. Then add back tax. Then 5 adjustments. Correct? Add back depreciation and OAS. That wala format. So first I will reduce depreciation. Depreciation or incremental depreciation? Incremental depreciation. We have to find or already found? Already found in the previous. So this is there, no? This depreciation each year you have to copy paste into the table. Same, whatever is there. 1 or 2 I will quickly show. 26,250, 24,281. 26,250, 24,281. The same value you have to copy. From earnings before depreciation, if you reduce depreciation, what are you going to get? Earnings before tax. Here it's earnings or everything on incremental basis. Every data here is on incremental basis. You can give the heading itself as incremental cash flow. That way you don't have to write incremental everywhere. It is understood that every data is on increment. So this is earnings before tax. From this, what are we going to do? Reduce tax. What are we going to get? Earnings after tax. These are simple numbers. No, it's okay, right? Simple calculations. And now 5 adjustment. Tell me people, what are those 5 adjustment? Add back depreciation. Whatever depreciation you reduced here, add it back here. And then OAS. O for opportunity cost. Luckily not there. Even if it is there, it's a simple faltu adjustment. There are no, they aren't there. So opportunity, I have not written. If it is there, right. In your mind, you call out for yourself OVAs. But zero components, no need to write an exam. Opportunity cost, not there. Then W for working capital. We read the problem, not there. Next. A for additional investment. We saw anywhere. We are buying a new asset in 4th year or additional working capital 5th year required. Blah, blah. There or not there. Last, salvage. Salvage value Allah. Incremental salvage value. Every number on a incremental basis. How do you get incremental salvage value? Old ka with new ka. Sir, they told in the problem, old asset if you continue to use for 10 more years, what will be the salvage value? 0. Old asset ka, if you continue. So here the decision is that only, no, to continue with old or go with new. If you continue to use the asset for 10 more years, its salvage value is 0. But if you buy a new asset, salvage value after 10 years will be 35. Old ka salvage value 0, new ka salvage value 35. So is new having an extra salvage value? How much? 35. That only becomes incremental salvage value. You'll get it every year or once. Which year? 10th year. Outflow or inflow? Salvage value means the money you get when you sell the asset. So it's a inflow. Which year? 10th year. So 35,000 you have to put it only in the 10th year. Check. This is your 10th year. Salvage value 35,000. All other column 0. OVAS over. Subsidy not there. Short-term capital gain is there. I will discuss that a little later. Why am I not doing here short-term capital gain is because of this culprit. They told in the question, ignore capital gain tax. Ignore capital gain tax. First, we will solve this question. Then I will tell you this concept using this problem only. If this word was not there, how we would have solved also, I will tell. But first, let's finish off this question. Now, people, once you do all this 4 adjustment, what are you going to get? Every year ka incremental cash inflows. Every year ka incremental cash inflows. Okay, people? Any problem? Now, when they ask you to decide, always take the decision based on NPV. If they ask for a selection rule, which technique you will use? NPV always by default. If they need other techniques like profitability index, IRR, question will specify. If they say just decide the selection, always decide based on NPV. Now to calculate NPV, what is NPV ka formula? Present value of cash inflow minus present value of cash outflow. Now this inflow, like here, 63,875, we'll get it now or after first year? This 63,280, this 62, you'll get it now or at the end of 3rd year? Means all these are what values? Future value. But we need present value. How do you get present value? Multiply discount factor. If you want, you can have one more table for NPV. Our question has already become lengthy, no? So anyway, we know this is a future cash flow. To get present value, we need to multiply discount factor. Multiply discount factor here only. You can save time. Otherwise, you have to take this data and prepare one more table for NPV. Faltu, not required. Here only we will do it. Future cash flow and multiply by what? Discount factor. Discount factor they told in the question. How much? 10%. So multiply discount factor. What are you going to get? Present value of cash inflows. Adding all this, you'll get the total present value of cash inflow as 394,611. I'll give you a minute. Just observe, ask me. Don't worry about this data. I will explain it to you later. Other than that, if you have any doubts or if you need some processing time, I will wait. This is something which you can acquire, or you can know all this only by solving up, people. There's some solving practice required for these questions. But yeah, we don't have that luxury of time now. But yeah, with the time available, I think this is the max we can do. Need a minute or okay now? Okay now, okay sir. Then this problem will get over. Another 5 minutes. Over. And now, what did we get? Present value of cash inflow. A wrong sentence. So, incremental present value of cash inflow. Don't forget that every number is on incremental. Now we need NPV or incremental NPV. Incremental. How do you get incremental NPV, people? Incremental present value of cash inflow minus incremental present value of cash outflow. Now, people, if you buy new asset, how much it will cost? 4,50,000. That is the value. Correct? But are we going to pay 4.5 lakh cash, or 1 lakh will be adjusted for old asset? 1 lakh will be adjusted for old asset. So how much cash will go out? 3,50,000. Comfortable, huh? That means how much? So salvage value of old asset 35,000 you should take, sir. Day. This 35,000, first of all, you will get it not now, after 10 years. And this 30,000 we will never get, because this 30,000 we will get if you sell the old asset in the market. Are we selling the market or giving to vendor? And vendor is not giving 30, he is giving 1 lakh. So, and for new asset, how much it will cost? 4.5 lakh. So that means will we pay the vendor 4.5 lakh or 1 lakh adjusted for old asset? 1 lakh adjusted for old asset. So how much cash outflow will happen? 3,50,000. This is extra outflow. Yes, no? Only if you buy the new asset, extra outflow will happen to the extent of 3.5 lakh. Agreed, people? So incremental present value of cash outflow is 3.5 lakh. Inflow ka value is 394. Outflow ka incremental value is 350. If you net off these two, you will get NPV or incremental NPV. Incremental NPV. Decision rule is still the same. If incremental NPV is 0 or positive, accept. If it is negative, reject. This we got negative or positive. That means you will reject the new machinery or accept new machinery. As incremental NPV is positive. Incremental NPV means extra machinery. If you buy extra new machinery, it will give you an extra NPV. Since new machinery is giving extra NPV as positive number, new machinery ka proposal should be accepted. That's the drama. Clear? Pakka na? So format will work, right? But all this drama you need to do. By the way, people, if they ask straight line method, tell me, let's do a quick comparison. Working note number 1, I will do na or cut na. What was working note number 1? Depreciation base. Depreciation base and all is required for SLM method or not required? Not required. This so completely cut. You will do the normal calculation. What is that? What is depreciation as on the old asset? What is depreciation on the new asset? Straight line method, you already know the formula. Original cost minus salvage value divided by life. It's not actually original cost, it's carrying amount. Leave that. Okay, na sir. So old asset ka depre, you compare it with new asset ka depre. And that way, accordingly, you will get what? Incremental depre. And since it is straight line method, will depreciation change every year or same every year? That means this working note cut, this working note cut. 2-liner answer. If it is straight line. If it is WDV, all this will work. Same format will work. Done na, people? And if it is WDV method, we know depreciation will change every year. That means cash inflow also will be same every year or change every year. So you can't have one column, you have to have how many columns? Full 10 columns. Done na? So those are the things. I'll take up 1 or 2 more questions. There we can discuss little more on that. Okay na, people, everybody? And now one small concept is there. I'll explain of using this question only before we proceed further. Sir, in WDV method, tax works on what basis? Asset basis or block basis? In WDV method, we calculate depreciation rather on a block basis. Now, what if block comes to an end? What if block comes to an end? Sir, if you have at least one asset in the block, that means block is continuing. All assets, if you have sold off, means block will come to an end because there is no asset, right? For you to call it as block, there should be at least one asset, right? Now, people, check same question. You had only, in fact, they told you this in the question. Check. What is that? Somewhere they mentioned. Consider that this is the only machinery is in the block of asset. That means in this block, how many assets are there? Only one. So currently we have an old asset. Now old asset we replaced with new. Old we replaced with new. Block will come to an end or new asset is there now? Since at least one asset is there, block comes to an end or block will continue? Got my answer? I'm talking about year 0. Year 0 mein what happened, people? Old one you sold, new one you purchased. That means how many assets are there in the block now? How many assets are there in the block? Old one gone, new one came. So how many assets are there? 1. Sir, if at least one asset is there in the block, means block has come to an end or block is continuing? Block is continuing. Done now. So at year 0 mein, has block come to an end or block is continuing? Block is continuing. There's no problem there. Correct? No, because old got substituted with new. Now imagine 10th year. 10th year, old one there. No, new one also you will sell at a salvage value of 35. Old already not there. I'm talking about 10th year. Which year? 10th year. Old one already sold at year 0 only. New one also sold at 10th year. That means any asset is there in the block or block has come to an end. Block has come to an end. Which year? 10th year. Correct? Pakka everybody? Now when block comes to an end, only when block comes to an end, we need to calculate something called short-term capital gain or short-term capital loss. I've showed the calculation for this problem, but in this problem, this value is not relevant. Why is it not relevant? Because in the problem, they specifically told to calculate capital gain tax or ignore. Hence, we don't have to calculate whatever I'm about to show you. If this line was not there, what you should do is what I'm about to show. Problem over, people. This is just for our knowledge sake. Sometimes they will say, ask us, they will not mention this word. That means you need to calculate short-term capital gain or short-term capital loss. How to calculate? Very simple. Here I've just checked. Now people, after 10th year, what is the book value of the asset? You already calculated here. Check your incremental depreciation working note. At the end of 10th year, what is the book value of the asset? 1,60,504. Correct? Yes, sir. So now check. WDV of the old or new plant and machinery. New plant and machinery at the end of 10th year. How much is that? 160,504. Okay. Now this one is there or you're planning, you'll sell it in 10th year. You will sell it. But you will sell it for 160 or 35,000? 35,000. Happy face or sad face? Sir, value, book value as per tax is 160. Right. He did not like it only. He became very sad. But we sold it only for 35. Value is 160. Sold for 35. So we made profit or loss. 160 worth of asset to 35 people. How much loss? 125,504. Agreed. Pakka. Sir, whenever you make profit, our Nirmala Sitaraman ji will say, tax kudra. Give me tax. Here it is profit case or loss case. On loss, you will pay tax or we will get tax benefit. You have studied tax and all, right? Because of loss, or in simple, if you have not studied also, no problem. In one liner, whenever you make profit, we will pay tax. But in the year of loss, this loss, you can adjust it with the next income. So on loss, we always get some benefit. So hence, this is what, sir? Short-term capital gain or short-term capital loss? They will give you a rate of short-term capital gain. You don't have to remember tax rates. If they may, here let's assume short-term capital gain is at 30% only. So calculate 30% of 125,504. 37,651. This much tax you will pay or get the benefit. Sir, if you're paying the tax, it is a cash outflow. When you pay the tax, cash will go out. Here you're paying the tax or getting tax benefit. Getting the tax benefit. So that means this number, you will show it as an outflow or an inflow. You will show it as negative or positive number. Positive number. All the 10 years or 10th year. 10th year. Done now. So if at all that word was not there, which word was not there? Ignore capital gain tax was not there. I would have one more column in my cash flow working, which is what? 37,651. Which year? 10th year. That is what I've written and cut off. If you just check here, I've written 37,651 and cut off. Why? Because the question said ignore capital gain tax. Otherwise, this number would come here as a positive number. Pakka na ji? Suppose it is other way around, Andre. Meaning, let's look at this. Book value is same. 160 how much? 204. Suppose salvage value of the new asset is 2 lakh. Assumed. Now sad phase or happy phase? Book value is 160. We are planning to sell this after 10 years for 2 lakh. I mean, this is a loss case or a gain case? Gain case. How much gain? These two come minus how much? 39,496. So on gain, will you get tax benefit or you have to pay tax? So what rate? 30%. So calculate gain is 39,496. That ka 30% you calculate. How much is it? 11,848. This is a benefit or tax to be paid? Tax to be paid. So it's an outflow. Every year or once? Which year? 10th year. So that means in this case, 11,848, you will show it as a negative number in your work. You will do all this only if the problem says what? To ignore capital gain tax or consider? Either they will say consider capital gain tax, or they will not say anything. If they don't mention anything, then you'll have to do this. Only if they say ignore, then we'll have to ignore this working. Done na people? So one extra working should come in case capital gain tax gets attracted. That's all. That way, this is a good revision question. WDV method, everything kind of covered. I think we have 2 questions in ICA material on the same lines. If you want one more, you can review it once. In our question material, we have, I think, at least 3-4 on this. Straight line, WDV, everything we have covered. I think we have discussed. That should be okay. Okay, now people. And now, next one. Baglama.
Straight line method is given. Can we consider the number which is given in the question?
Yes. She's saying I'll consider the depreciation value given in the question. In that case, they will not get depre value. You'll have to calculate. But if they have given, you can consider. Perfect. Move forward, people. I'll take that as a yes. Okay. Now, after that wonderful problem, can we come for a simple question? Or 1 minute, hang on. No? Maybe. Okay. People, I have plans to do 3 questions more. 3 means 10:30, 2 means 10. No. You decide. Oh. No. Okay, na. Pakka na. 3 means 10:30, pakka it will take. Are you ready to sit? 5 minute break illappa. Break now, I can't, recording is going on. No, recorded should be like a labo. Yeah, it will be a problem for them. Exam day, they'll be watching macha. Now if I give break, they'll have to keep scrolling, which I don't want to give them that trouble. Same only. No concept. Just whatever concept we have learned, quickly we need to apply. That's all. Easy peasy only. Don't worry. For you, what is difficult, macha? That's an chiller pillar. Okay, maybe since you said break, instead of break, we'll take a simple question. Okay, simple but a chintu, a good question. Okay, now check. Same study material question only. Navajivani Hospital is considering purchasing a machinery, some X-ray machinery they want to buy. How much value? 2 lakh. So this is inflow or outflow? Outflow. Found it. You're hunting for it. Found already. Awesome. He's like all the question number is there in my mind. Okay, projected life is how many years? 8 years. Salvage value expected is 18,000 at the end of 8th year. Okay. Annual operating cost is 20 to 500. The key word there is annual. Annual. That means every year cost is how much? 20 to 500. One happy face for me. Though the life is 8 years, I don't have to have 8 columns. I can have only 1 column. Because every year looks like the cost is same. Okay. Only thing I have to worry about is depreciation. I wish Jesus, Allah, Shiva, depreciation under straight line method, not WDV. Okay. If it is WDV, we have to put up a working note and we have to have how many columns for cash flow? 8 columns. Let's see what here. It is expected to generate a revenue of 1,20,000 per year. Oh, this is also nice. Every year, same sales. Presently, hospital is outsourcing radiography to its neighbor. Currently, we don't have X-ray machinery. So, whenever a patient needs X-ray, we are referring to our neighboring diagnostic center. We are giving them business. Do you think we'll give them business at free of cost? No? There are so many diagnostic center. I can give it to so many. But I'm giving it to one specific diagnostic center means I'll take a cut. I'll take a commission. So, check. We are outsourcing this to neighboring test center and we are earning a commission of 36,000 per annum. Net of tax. This is after tax. Currently, we are getting this commission. Why? Because we don't have X-ray machinery. Hence, we are outsourcing this work to test center. Now, if we buy our own X-ray machinery, will we outsource the work or we will do it ourselves? We will do it ourselves. If you don't give this works to the test center, will he give this commission or commission lost? Commission lost. What is this? Opportunity cost. Inflow na outflow na. Inflow na out. Opportunity cost can be both plus or it could be minus. Plus minus. Minus. Why? Sir, one income we are losing. Till now we used to get to this income. But the moment we buy this machinery, we will lose this income. One income if you are losing means income is reducing. Income is a benefit. One benefit if it is reducing means what is it? Outflow. That means you will put what sign? You will put it as a negative sign. Luckily, this income you will lose it only 1 year or every year. I mean, this also opportunity cost also will come every year. For how many years? 8 years. That means looks like every data we have read is changing every year or same every year? Same every year. Awesome. Analyze whether it would be profitable to buy the asset based on NPV technique, profitability index technique. So Depri, they have not told anything. In FMA, one convention. If Depri method not given means always SLM. Always what? SLM. You will do WDV only if the question mentions. Don't use your income tax rule. Income tax rule says every company should follow WDV method. Only power generating unit can go for SLM and all. No, here it is ulta. In FMA, for all our questions by default, we will take what? SLM. We will take WDV method only if the question mentions. Any mention or no mention. That means J. SLM. SLM means every year ka Depri also same. So 8 columns for 8 years or 1 column enough? 1 column enough, because every year ka cash inflow is going to be same. Even if you put 8 columns, wrong, no, but you will get the same data every year. Waste of time. That's all. Okay, Naji. So this is one. Before you proceed the question, ask this question. Should I have many columns or 1 column? When you will have many columns, when cash inflow is changing every year. Okay. But if every year ka cash inflow is same, means you can have only 1 column. And so I'll solve this under 1 column approach. Pakka na. Now people, to calculate NPV, we need cash inflow. Have they given cash inflow or have they given sales? So tell me the order now. From first, what do you do? From sales, you will reduce operating cost. 2 expenses you will reduce. One is operating cost. Another one is depreciation as per SLM. Then you will get, or maybe we'll do it here only. Check. What is the sales, people? Quickly confirm. Sales is 120. Operating cost is 22. 500. Calculate depreciation also for me straight away. 1. Incremental approach or normal problem? Sir, incremental will come only when you are replacing existing asset with new asset. They will give you existing asset data, new asset data. Only then incremental. Here 2 data available or only 1? Normal problem. Calculate depreciation. You bought the asset for 2 lakh. Salvage value is 18,000. So 2 lakh minus 18,000. Original cost minus salvage value divided by life. How much, people? 750. This is a depreciation every year. Okay. Now that means 3 data. Sales how much? 120. Cost, operating cost 22, 500. Check. Take a now. Sales 120, operating cost 22, 500, depreciation 22, 750. That's all. From income, if you reduce all expense, you will get profit before tax. Reduce tax, you will get profit after tax. Now, 1 minute. Everyone check the screen. From PAT, there are 5 adjustments. What are those? Add back depreciation, add back OAS. Be little careful over here. Are we having 10 columns or 1 column? Why? Because every data comes every year. Different value, same value. One by one we will see adjustment. First you add back depreciation. Depreciation will come once or every year? Every year. So that means, can I add bindas? Yeah, add back depreciation bindas, because it is coming every year, same value. And then over opportunity cost. There are, yes. Now people, this number is on a before tax basis or after tax? So opportunity cost also should be on after tax. Here have they given opportunity cost on after tax? Good. They only given net of tax. Net of tax in after tax. How much is that? 36,000. Sir, suppose if this was before tax, we have to do something on after tax. How do you get in FM after tax basis? Take the number and multiply 1 minus tax rate. You will get after tax. But here we have to do this or already on after tax basis. So that means take the number as it is. Yes, sir. Now everybody got it? No. Both adjustments are tested in the problem. Okay. And now 36,000. We have to take it as positive number or negative number? Negative. Why? One income we are losing. One benefit we are losing. So 36,000 will be negative. Considered. Yes. Negative. O over W. W for working capital. There or not there? Not there. If it is there, will you bring it in this table or you cannot? In this approach, can you bring this? No. If you write, suppose working capital was 1 lakh. If you bring it in here, what does it mean? Sir, this is annual cash inflow, meaning data repeats every year. Additional working capital and all will come every year or only at year 0 and year 0 may outflow, end of the project inflow. That means OAS works, but here you can't put in, you'll have to put in the NPV table. Okay, now I'll show you once again if you want. Anyway, not there. A for additional investment, there or not there? Not there. If it was there, would you have put it in this table? No. Why? Because it's not repeating every year. It comes only once. If it comes only once, put it in the next table. How I'll show you for salvage value. Last is S. S for salvage value. It could be subsidy. It could be short-term capital gain or short-term capital loss. Here anyway, they've not told anything about block. Moreover, we are not doing block method. We are following SLM method. So SLM method, irrelevant. Leave that. Subsidy, not there. Salvage value irka. How much? 18,000. Salvage value outflow or inflow? Inflow. Can I say plus 18,000 here? Sir, if I write plus 18,000 here, it means this 18,000 we will get every year. Salvage value you will get every year. No, you will get only once. We have to consider salvage value, but we can't consider it here. I'll consider it in the next table. Why? Because it doesn't come every year. Okay now people. So how much is your net annual cash inflow? We have got 39,075. Now calculate the NPV. NPV ka normal table. Year cash flow discount factor, present value. Year 0, how much did you invest to buy the asset? 2 lakh. Now this 39,075 is changing every year or same every year? For how many years? 8 years. So that means should we have PVIF or PVAF? If every year if you're getting same cash flow, we can take PVAF. Year column what I'll write? 1 to 8. How much cash inflow? 39,075. So at 10%, give me PVAF for 8 years. 1 divided by 1.1, press equals to button 8 times and then GT button. 334. Multiply and you will get the present value. Done now. Now few things we ignored. What are those? OAS. OAS mein opportunity cost will be considered. Yes. What about W? It was not. It was not there. Suppose it was there. Working capital. Anyway, we'll consider it year 0 and also you will have one more year column 8 and bring it in this table. Got it? And which one else we ignored? Salvage value. We did not consider salvage value in this table. Why? Because it does not come every year. Which year salvage value comes? Year 8. So hence the year column have 8 and what is this? 18,000 salvage value. If you can't consider in this table, put it in this table. Done now. Whichever data repeats every year, put it in here. Whichever is not repeating, put it in here and finish it off. Okay, na sir? The salvage value outflow or inflow? Inflow. Every year or once? Once. That to which year? End of the project, which is 8th year. So we will take PVAF or PVIF. 1 divided by 1.1, press equals to button 8 times. You will get it. And it's your cash flow. And NPV is positive. So reject or accept. Decision is accepted. Then they ask profitability index also. That is very simple. Now these two are inflows. This is outflow. How do you get profitability index? Present value of cash inflow, which is this, divided by present value of cash outflow. That's what I've done here. Okay, sir. Simple problem, but good problem still because of the opportunity cost. One subtle adjustment for opportunity cost is also, don't forget, opportunity cost also should be on a net of tax basis or after tax basis. If they don't mention or if they say if it is before tax, then you have to take the number and multiply 1 minus tax rate and then only take it. That's a hidden adjustment. Some questions may it is tested. This question over. Need 1 or 2 minutes to review or sorted? Or take away or tell me this takeaway of this particular question. 1 WDV method not there. It is SLM. It means every data is same every year. 8 columns or 1 column is enough. 1 amount column is enough because every data any which way is same. From sales, first you get PAT by deducting all the expenses. After PAT, 5 adjustments. Add back depreciation. Depreciation will come every year, so you can aram se bring it into this table. Opportunity cost also will come every year. You can put it. Working capital, additional investment, salvage value. In this approach, can we capture here or next table? Next table. Because they don't come every year. They come only in a specific year. Hence, you'll have to bring it to the next table. Still, the checkpoint is still OAS only. Here, you can't come in. It has to come in here. That's it. Next question, Asarji. Next question, Asarji. Yo, Papa. Okay, how many more I told you? 1, 2, 2 more. That's all. Okay, we'll see. We'll see. Maybe 10, 15 we will try. We will try. If you're hungry, you can eat in the class. I have absolutely no issues. Feel free. I will not put kannu. I can't say the same thing about your neighbor. Share and eat. Better. Not with me. I'm fine. Yeah. Okay. Yes. 31. Again, I think this also is a study material question only, or maybe some RTP question. I think mostly study material. Okay, question number 31. I'm taking those questions where I can cover the concepts. Okay, and also more or less all the concepts I want to cover. That's the intention. Now people, check this question. 31 no. 31 no. Carefully read the data. XYZ is planning. Simple question only this is, but good number of adjustments are there. XYZ is planning to introduce new product with a life how many years? 8 years. Initial equipment cost is 3.5 crores. So that they said initial equipment cost. So investment will happen at year 0. Inflow na outflow na. This is year 0 ka outflow, 3.5 crore. Not only that, we also need additional equipment costing 25 lakh. When? To be purchased at the end of third year. You remember OVAS? OVAS mein there was A. What was A? Additional investment or additional capital. Here you have to buy one more asset by paying how much? 25 lakh. When? Now a third year. This is your additional investment we are talking about. Clear? That means you need to be little careful. We have one asset or two asset? Original asset, additional asset. Original asset ka depreciation starts from first year only. But additional asset you purchased only at the end of third year. That means additional asset ka depreciation only will come from year 4 to year 8. That means we need to have a depreciation working out here. I think it's a straight line method only, but still we need to have a working note for that. At the end of third year, original equipment, no salvage value, no resale value. Additional equipment can be sold for 250. So what is this? Salvage value. When you will get? Now or 8th year? 8th year. Every year or once? Once. That too in 8th year. A working capital of 40 lakh is there. You already know the concept. For working capital, what you will do? At year 0, it will be an outflow. End of the project, which is year 8, it will be an inflow. Same number. Clear? And that means at year 0, there is one outflow or multiple. What I would suggest is, at year 0, if you have multiple outflows, have a separate working note. Otherwise, not required. Here at year 0, you're buying an old asset or an asset for how much value? 3.5 crore or 350 lakh. And working capital, how much you are investing initially? 40 lakh. So total will be 3 crore 90 lakh or 390 lakh. If there are multiple adjustments, better to have a working note in my view. Okay. Now it will be released by the end of 8th year. Should they have to tell this? We already know working capital. We any which way we assume that at the end of the project we will recover or release, one and the same. 8th year they are saying it is an inflow. They don't have to say any which way we will do the same assumption. Project will be financed by sufficient equity capital. Their headache. Sales volume, sales volume over 8 years. I don't like this. They gave number of units sold, same every year or different every year. Asho, karma khanda. So what now? One column, 8 columns. 8. Ayalada. Year 1, 2, 3. 4th year, 5th year, every year 2,70,000 units. This is 6th year, 7th year, 8th year, every year 1,80,000. Life is how many years? 8 years. 8 columns. You can have 4 to 5 as 1, 6 to 8 as 1. If you are comfortable, but I prefer to have it separately because some students may get confused with that. So I have done 8 columns. The culprit here is what? Sales. Okay, this is what sales are or number of units sold are. What is selling price per unit? 240. So by now we got to know that we have to have 8 columns. So I think so far I figured out 3 working notes. Can you tell me what are those? Working note number 1 for outflow, because there is working capital also, addition thing also. So I'll make one working note for year 0 outflow. Next, one working note for depreciation, because we don't have one asset, we have 2 assets. Third year for annual cash inflow. 1 column approach or 8 column approach? 8 column approach. Yes, Ajay. Can we, Fadafat, so far whatever we added, can we finish it off? Year 0 outflow, tell me people, how much? 350 lakhs plus 40 lakhs. Check. 390 lakhs are working note number 1 over. Outflow means showing it as negative number. Then depreciation. Calculate depreciation. Original asset you bought for 350 lakhs. Salvage value 0. Life is 8 years. What is depreciation every year? By default, I told no, if they don't mention the method, it is always straight line. Calculate. 43.75. This is on what asset? Original asset number 1. Asset number 2, when did you buy? Asset number 2, you bought it for 25 lakh when? Third year ending. So depreciation on asset 2 will start from fourth year beginning. 3 years at the end of third year you purchase. So depre will start from fourth year and project will end at 8th year. So for first 3 years was new asset 2 there or not there? So asset 2 was there in the project only for 5 years. So take original cost 25 lakh, salvage value they have given how much power? 2,50,000 here. You bought it for 25 lakh, salvage value 2,50,000, life 5 years. How much? 4,50,000. Okay, people. Now check how I presented. For year 1, year 2, year 3, we only have original asset. That means every year depre will be 43.75. But from year 4 onwards, original asset ka depre will be 43.75. Asset number 2 ka depre will get added 4.5. So from year 4 onwards, depreciation will become 48.25. It will change or 48.25 from now onwards same. That's a presentation. Done now. Can we move on to the next? Next is your cash inflow. 1 column approach or 8 column? 8 columns. They have given number of units sold. People here be careful. Here they have written 4 to 5, right? 4th year, 5th year put together it is not 270. 4th year also 270. 5th year also 270. Here also same thing. 6th year 180. 7th year also 180. 8th year also 1,80,000. So this is the number of units. How do you get sale value? Number of units multiplied by the selling price. When the numbers are big, try to present in lakhs, hundreds or crores. I think here I present it in lakhs. So 72,000 will become 0.2 lakhs. 0.2 lakhs into 240 you do. 1 or 2 years you do. 0.72 into 240. How much are you getting, pa? 172.8. 1 or 2 I'll quickly show. Next year you calculate 1.08 in lakhs. 1.08 into 240. 259.2. So on and so forth you do it. This is your sales. Next, what have they given? Variable cost is 60% of sales. This is easy, no? Sales ka 60%, if you calculate, you will get the variable expense given. Just sales ka, this number ka 60% you'll have to do. Manageable. Next, what expense given? Where is it, pa? Where? Huh. The people, they did not say fixed cost. They said fixed cash operating cost. Fixed, the keyword there is cash. Fixed cash operating cost means depreciation included or excluded here. Depreciation is a non-cash expenditure and here they told fixed cash operating cost is 36 lakhs. So depre here included or excluded? Excluded. Excluding depreciation, your fixed cost every year is 36 lakh. So bring in that 36 lakh. Now depre we already know. For first 3 years, what was depre? 43.75. From year 4 onwards, what is the depre? 48.25. Copied that. Done now. Over. No other expense. I don't think so we have any more expense. Easy. Tax rate how much show? 30%. Discount factor how much they're saying? After tax cost of capital is nothing but discount factor which is 12%. At 12%, good thing they only given PVIF. Okay, sir. One more sentence is there. I'll talk about that in a bit. This one I'll tell you. But everything is okay, no? From sales, if you reduce all the expense, you will get profit before tax. Easy. Now everyone just check the screen for a minute. When you did sales minus all the expense, concentrate on the first year. You got profit or you got loss? Loss. How much? 10.63. Easy. Correct? All the other years are profit. Profit means you have to pay tax. No problem there. But loss we got. We just now studied short-term capital loss and gain. On the profit you will pay tax. On the loss you will get tax benefit. But 1 minute. So ideally what you should do? Tell me according to you. Okay, or maybe first I'll tell you this. Check for 4th year. How much is profit for 4th year? 174.95. What is the tax rate? 30%. So how much tax? Calculate 174.95 into 30%. 52.485. This tax we will receive as a company, we will receive or pay. So inflow or outflow. So this is negative. Correct? Huh? On the same way, here it's a loss. Here it's a loss. Ideally, your mind or heart to kidney is saying what? On loss, we get tax benefit. benefit means negative or positive? How you will calculate? 10.63 ka 30%. 10.63 ka 30%. How much is that? 3.18. This should be negative or positive number? Positive number. Yes, sir. That's what your suggestion is. Correct only. But one sentence they've used in the problem. First read that. Loss of any year will be set off from profit of the subsequent years. Any year if you get a loss, no, you can adjust it. Income Tax Act allows you to carry 7 years or 8 years. 8 years. Okay, leave. But here we'll go in FMA, we will follow question ka guideline. Never question the question. Go with the flow. Loss of any year will be set off from profit of how many years? 2 years. So question is saying any year loss if you get, you can carry this loss forward and adjust with the next 2 years ka profit. When they say this, right, when they use this sentence, the year you get a loss, that year you make the tax to be 0. Now, this loss you can carry it and adjust for how many years? 2 years. Next year, no people, you will not pay tax on 23.93. Whatever loss you made, first you will adjust. From 23.93, adjust the loss of 10.63. 23.93 minus 10.63. Okay, I'll only do. No need to do. 23.93 minus 10.63 you do. You'll get some profit. On that you calculate 30% tax. Got it, huh? This is your carry forward option. Done, everybody? So you will do this when the question mentions the carry forward point. If the question does not mention anything about carry forward point, year of loss only you take the tax benefit. You said no 3.18 something, no? That you write it in the first year. Two approaches. Both, did you get it? What does that summarize that for me? If they don't say anything about carry forward, then whichever year you get a loss, you take the tax benefit. You write tax as a negative number or positive number. How? Take this number and multiply 30%, you will get 3.18 something, no? Add that. Which year? That respective year. But if the question says carry forward the loss for 4 years, 5 years, then in the year you made a loss, make the tax as 0 and adjust this tax loss with the future year profit and accordingly calculate tax. Everybody good? This is a new adjustment. That's what I've written in the chart. I'll quickly show you. Or maybe last page I will show it to you once again. Now we have covered all the last page ka adjustment through problems. Now afterwards, any drama or no drama? Loss got adjusted in first year only, no? Or rather, first year ka loss got adjusted in second year. So from year 3 onwards, same drama. So you got profit after tax. From profit after tax, 5 adjustments. What are those? Add back depreciation. Whatever you have deducted here, add back. Then O was. O for opportunity cost, not there. W for working capital is there. How much working capital? 40 lakh. You already considered as year 0 outflow. Now, inflow. End of the project inflow. Here, project is ending at year 8. Year 8 mein 40 as an inflow. Yes, sir. And then A for additional investment. There. You bought a new asset. When? Third year ending. How much? 25 lakhs. Third year ending, you bought a new asset by investing 25 lakh. Coming in or going out? Outflow. So, negative. Yes, na Ji. Last, S for salvage value. Eureka. Yeah. New asset has a salvage value of 2.5 lakh. Old asset, no. Additional asset, 2.5 lakh. Any subsidy, Eureka? Ledo. Short-term capital gain concept, not there. So, 2.5 lakh salvage value for asset number 2. Which year? 8th year. Outflow or inflow? Inflow. By doing this, you will get annual cash inflow. But all these are present value or future value. Multiply discount factor and you will get accordingly present value of cash inflow. Total them up and you will get total present value of cash inflow. This is your present value of cash inflow. This is your present value of cash outflow. This is your present value of cash outflow. When you net off, you will get NPV. And NPV is positive. So reject or accept. Just the format. It will take time to solve this. Conceptually not difficult. If you are able to, even on the examination day, you should revise this only. What adjustment will go where? That's all you need to revise. Don't waste your time calculating each component. That anyway, your mind will do that on the last day. Now focus more towards where, what numbers. That's it pretty much. Okay, now see only this much. Chiller. Correct? No. Last question for the day. Chudama. 1 minute. First. Raja, Kanna, ikkada chudupa. Carry forward loss. Two things we learnt. What is that? When question mentions loss can be carry forward. In the year of loss, you will make taxes 0 and adjust this in the future year. If the question is silent, if they don't mention anything, what you will do? In the year of loss only, you will take the tax benefit, meaning you will make the tax as a positive number. That's what I've written here. Makes sense, huh? Short-term capital gain loss, we have already explained through the problem. I'll not go through this again. This is your depreciation base. Tell. First of all, this is only applicable for WDV method. And I'm asking you under incremental approach. Step number 1. Calculate depreciation base of the old asset. Calculate depreciation base of the new asset. How do you get this? Take old asset ka book value, add purchase cost of the new asset minus salvage. By comparing these two, you will get incremental depreciation base. On this incremental base, calculate depreciation, which you will get incremental depreciation. That's all I've written. Last, don't forget OS, which we're never forgetting. Okay. One more is there. This is not subsidy rather. Subsidy from government is there. One point is there over here. It was tested in a couple of questions. No time for questions. So I will quickly tell you what you should do in that question. Only this was an extra adjustment. First of all, subsidy means we are paying the government or receiving from government. Receiving from government. There are two ways through which subsidy question can be asked. One, they will say, company has purchased an asset. Company has purchased an asset. Because of that, government gave subsidy. Tell me back once again, what is that? Company purchased a particular fixed asset, machinery, whatever. Because of that, government gave a subsidy. That is one approach. Now you tell me, or maybe I'll give you some numbers. Let's say people, pink, no purple, okay, no pink. Now I don't mind using pink. All right. Let's say people, we purchased the asset for 10 lakh. We purchased the asset for 10 lakh. Government gave a subsidy of 1 lakh. Government gave a subsidy of 1 lakh. How much did we buy the asset for? 10 lakh. How much we got a subsidy? 1 lakh. Now touch your heart and tell, is the cost of the asset really 10 lakh? 10 lakh. Why? On one hand, you are paying 10. On other hand, you are receiving 1. That means the cost of the asset is really 9. Correct, Aji? So this is your cost of the asset for what purpose? Depreciation. Now you will not calculate depreciation on 10 lakh, you will calculate it on 9. When subsidy is related to asset. When subsidy is related to asset, first reduce the subsidy and then only you calculate depreciation. Goinda, got it? Everybody. He's looking at the door only. When will I go and have sapad da? He's literally sitting like this only. Straight door, nera. We'll go much. 5 minutes, that maybe 15 minutes much. Like tanga mudila sir. Too much blood you are putting today. Okay, no problem. You can revisit. Again, we'll upload this particular video on YouTube as well. As a marathon, we will upload it in about 2-3 days. They have to collate and upload. They may take another 3-4 days time. It will be there. So if you want, you can watch it again later on. Okay, no macha. Now he's saying I'll walk out of the door only. Now, what is this concept? If subsidy is related to the asset, though you purchased the asset for 1 lakh, whatever subsidy you have received, first reduce and then calculate depreciation. If it is related to the asset, they will tell the problem. Another way they will say, since the company is operating in a special economic zone, government is giving a subsidy of 5 crore. Now you tell me, is this subsidy related to a specific asset or a business? Because we are doing a business in special economic zone or SEZ, we got a subsidy. Is this related to any asset or not? Now you will reduce the subsidy for depreciation calculation or don't reduce. That's also point. Rest everything same. If it is related to asset, reduce subsidy and then calculate depre. If it is not related to asset, do not reduce the subsidy for depreciation purpose. Done, Sarji. That's all. It's a concept. Now, last question. If you want to do it, we'll do it. Otherwise, this question we have anyway done it in our regular class. But there's an RTP question also. Many long years back it came. RTP May 2019. No? I think in 2025 MTP, RTP, MTP also they repeated the same question. We have done the same question. We have done it in our class. It was question number 39 in our class notes. Okay. If you want, we will do. Where we will watch the recording. We will. Tatastu sapad. Do means 20 minutes. Okay. You were saying something, ma.
Subsidy should also consider again in the OAS.
Sir, she's saying subsidy again you will consider in OAS. Yes, ma'am. Absolutely, yes. That's the reason. Last S is for 3 things. Don't forget. In OAS, last S is for 3 things. Salvage value, subsidy, STCL or STCG. So that's made it as common. Yes, it will come. That's a valid question. Now, 39th. Yeah. Okay, yeah. Don't worry, by 2:30 I think we should be done today. Not much. This was the biggest topic. Next two are pretty chiller pillar. So I want to do the biggest one first. Where our energy is full, no. After this, so we'll be like that wala feeling. So I don't want to take up this topic at that point of time. So fine. BT pathology lab is using an X-ray machinery which has reached the end of. People here, we don't have to solve all the question over here. One adjustment, or rather I would say 2 adjustment is good over here. It's definitely a lengthy question, but only 2 are different, or you could say, yeah, little thing you need to pay attention. Rest all, everything is just format will automatically take care. Pay careful attention to while reading. Now one lab, they are using X-ray machinery, but that X-ray machinery is almost reached the end of life. Following new X-ray machine from 2 different brands with same features are available. Now we want to replace. The moment they say replacement, our mind should run towards incremental. But if you just check, have they given existing machinery ka data? They have only given new ka data. So can we do incremental or not possible? Not possible. For us to do incremental, we need old asset ka data, new asset ka data. Compare and then only we will get incremental. Here old one not given. So this is not incremental approach, it is normal problem. Everybody has come to first that understanding. Now option, we have 1 asset or 2 assets to buy. Either we can buy brand XYZ ka new asset or brand ABC ka. If you buy XYZ, how much it will cost? 6 lakh. Life is 15. And this is the benefit alag prabhu. This is maintenance cost. This is also cost too. This cost you will incur at year 0. This cost you will incur every year. From year 1 to 5, every year how much cost? 20,000. 6 to 10 every year, 28,000. 11 to 15 every year, 39,000. Depre rate, 4%. If they don't give depreciation method, we always SLM. If you go and buy a new asset from ABC brand, it will cost 4.5, but life is only 10. Stop there only. Life same, unequal. Unequal life means first thing is, that should always come. So there's a normal problem clubbed with EAC. EAC will always come when the life is different. So we can't just calculate NPV and leave it at that. We have to calculate EAC and do it and then give the suggestion. Now 10 years, first 5 years 31, next 5 years 53, depre 6%. 2 options. They didn't leave it at that. Check. I'll come to this in a bit. Check. Alternatively andre, one more option. The machinery of brand ABC can also be taken on rent and returned back to the owner with the following condition. So how many options? 3. Either you can purchase XYZ, purchase ABC or take ABC on rent. So 3 options you need to solve and suggest which one to go for. Okay na sir? Now if you're going for rent option, careful. Annual rent shall be paid not at the end of the each year, at the beginning of each year. So first rent you will pay at the end of first year or year 1 beginning only? Year 1 beginning andre year 0. Careful. How much? 1 lakh 2. Annual rent for the subsequent 4 years will be 1 lakh 4. But mind you, every rent is not at the end. It is at the beginning. Okay na? So that means first rent you will pay at year 0. Then at year 1. Then at year 2. Then at year 3. And year 4 like this. Okay. Then for the next final 5 years rent is 1019. That is a breakup they've given. 10 rents, when you will pay, how much you will pay, they've given. Every year, same. Rent agreement can be terminated by BT Labs by making a 1 lakh payment as penalty. By chance, if you cancel the lease, you have to take the lease for how many years? 10 years. By chance, if you cancel, you have to pay how much penalty? 1 lakh. But this penalty will reduce by 10,000 each year for the period of rental agreement. If you take the asset on rent for 1 year, how much minimum period you should take for? 10 years. After 1 year, if you cancel, if you cancel, you don't have to pay 1 lakh penalty. Each year you use the asset, penalty will keep reducing by 10,000. So that means after 1 year, if you cancel, then you'll have to pay how much penalty? 90. After 2 years, if you cancel means 10,000 minus 10,000, which is 80. Like this. Next May, they will say some year we will cancel penalty. Matlab, you will cancel lease. Maybe that's why they have given this adjustment. We will see. You are required to advise X-ray machinery. Say the period is 20 years. Keeping the period as 20 years. Faltu. Any which way I don't need this. Because I am anyway working out this problem on EAC. Because these two periods are same or different? Different. Now here they can say 20 years or they can say 200 years. To hell with them. I'll just do EAC. Life is different. So absolutely EAC. Pakka na. Second option we will say different. Cost of capital. Discount factor how much pa? 12%. Can we do it? If you read the question, this is cost 2. This is also cost. Where is benefit? Not given. So EAC from benefit angle or EAC from cost angle? Cost angle. But there is one benefit. That's all. Rest all benefit not given. Okay, now people. So that means, sir, looks like in this problem, cost is more, cost only is more. No, benefit they have not given. That means still EAC only. So we'll have to work it out accordingly. If you want, you can change the signs here because all these are on cost. No. If you want in this problem, you can, or maybe I'll come to that. Hang on. Maybe this alone I will read. This is one highlight of the question. This and EAC. Rest everything is faltu. Just lengthy ashte. So observe everybody this. Residual value of both the machinery shall be dropped by 1/3 of the purchase price in the first year. Take your calculator. First for XYZ. What is the purchase cost of the asset? 6 lakh. How much it shall be dropped? They are saying 1/3 of the purchase price. Purchase price is 6 lakh. 6 lakh ka 1/3 is how much? 2 lakh. Which year? First year. When they use this sentence, what they mean is depreciation for first year is 6 lakh ka purchase price ka 1/3. That's what they are trying to say over here. Residual value dropping is nothing but your depreciation. What is depre for first year, people? 6 lakh ka 1/3. How much is that? 2 lakh. From then onwards, what is the depreciation? 4%. What is the total life of this asset? 15 years. First year ka depre we have already got. Then how many more years we need to find? 3 years, 14 years. 14 years, yes. What is the value? How do you calculate? 6 lakh ka 14% into 14%. How much is that? Calculate. 3,36,000 you're getting Didn't understand? Once again. What is first year ka depre? Everyone understood that? 2 lakh. That part is clear, everybody? From year 2 onwards, the depreciation rate indirectly they're telling is 4%. 4% on what? Same purchase price. How much is that? 6 lakh. If you do 6 lakh of 4%, you will get depreciation for 1 year. We need it for 1 year of remaining 14 years. So what is the depreciation for remaining 14 years? I'm asking. 6 lakh of 4% into 14 years. Clear? How much is that? 3,36,000. Done na, Sirji? Everybody good? Pakka na? Now, everyone check. First year ka, take a calculator. First year depreciation how much? 2 lakh. Balance 14 years, how much depre? 3,36,000. So how much is the total depre you have charged? 5,36,000. In 6 lakh mein se 5,36,000 you have depreciated. How much you did not depreciate? That only is salvage value. Because what is straight line method ka formula? Original cost minus salvage value. I mean, will salvage value get depreciated? No. From original cost, you remove salvage value and the balance will get depreciated over life. Correct? No? In this problem, salvage value was not given. That is the crux of this question. Yes, sir, people. That means another way. What is that now? To get salvage value, what is another way? From the original cost, reduce the total depreciation. Automatically, you will get what? Salvage value. Clear? Pakka na? Pakka. If you have understood, for ABC brand, for the next asset ka, you will calculate salvage value. Can you calculate? I'll read the data for you. One minute, careful. What is cost of XYZ? 4,50,000. Same thing. They said residual value of both the machinery shall be dropped by 1/3. Which year? First year. Thereafterwards, it shall be depreciated at the rate above. Thereafter means from year 2 onwards. Question is saying. So now first you tell me, what is depreciation of ABC for first year? How did you calculate? Cost, purchase price ka 1/3. 4,50,000 ka 1/3. How much is that? 1.5 lakh. Pakka. Thereafterwards, you will calculate depreciation for 14 years or 9 years. This asset ka life is only 10 years. 1 year, first year depre you have already got. Remaining is how many years? 9 years. How will you calculate? 4,50,000 ka 6% into 9 years. 1 lakh? No, here I am getting 243. 243, correct? This is your total depreciation. From original cost, if you reduce total depreciation, what are you going to get? Salvage value. Understood? The whole crux of this problem, one main crux of this EAC, any which way we know, the main crux of this problem was only salvage value. I've just written it here. If you have any doubt, ask, or if you're comfortable with the number, I'll move forward to the next. Pakka ji, whether understood or not, go you tell it. Easy only, no? Manageable, right? Here residual value getting dropped, if they say mean, that is nothing but your depreciation for that particular year. Which year it got dropped? First year. So first year ka depreciation is that. That's what the question means by this. Okay, this is sorted. Now, normal problem. This is also cost. All these are also cost. Only one benefit is there, which is what? Salvage. Sir, you can solve under normal approach. But under normal approach, outflow cost we show it as negative, benefit you show it as positive. But here if you just check, no, they have given lot of data in cost and only one benefit is there. Hence what ICA has done is cost data they presented in positive, salvage value they have been presented in negative. Because it's easy to work with positive number than with the negative numbers. So that's, if you want, you can stick to the normal one. All the cost you can show in negative, salvage value you can show in positive. So your final number will be negative and EAC also will be in negative. Decision making you need to be careful. With the decision, no, when two negative numbers are there, when you ask to compare, some students will be like, easy to compare with the positive. Hence, I would suggest for exam, when they give you all cost data, when they give you a lot of cost data and very less inflow data, make the cost as positive. Benefit, you make it as negative. Easy for decision making. Comfortable? So that is what they have done. Here, check. Everything they have only given. We just need to solve. Here, let's review this question. First, let's do it for machinery. Machinery, what is that, pa? XYZ. Let's get the basic data right. For XYZ, where it went? For machinery XYZ, what is year 0 ka outflow? 6 lakh. You're buying it initially, no? So year 0 ka outflow is 6 lakh. Have they taken a? Yeah, year 0 outflow 6 lakh. And here all the cost in positive number, salvage value in negative. We already got salvage value. What for XYZ? What is the salvage value we got? 64. They have taken that. I'll come to that. Here they have taken 64 and they have taken it as negative. Salvage value you will get now or end of the year. What is the life of this asset? 15 years. So 15th year you will get salvage value 64. Okay now people. Now what about year 1 to year 5? Benefit or cost? Cost. So we are showing negative or positive here? Positive. Since is the cost different every year or same every year? So you want to do it 15 years separate column. Problem will become lengthy. We'll use PVIF or PVAF. So in the year column we'll write 1 to 5 and take how much? 20,000. Take na. What is the discount factor? 12%. Tell me people, for 5 years, what is the discount factor at 12%? 1 divided by 1.12, press equals to button 5 times and GT button 3.605. This is your future cash flow, multiply and you'll get the present value. All that is common. One more hidden adjustment over here. It's not hidden. We have done 2 questions in regular class on this. But anyway, just check here. Year 6 to year 10, how much maintenance cost? 28,000. Different or same every year? 6 to 10, 28,000. So 6 to 10, how much? 28,000. Now, how to find PVAF for this? If they ask for 1 to 10 years, very easy. We'll press equals to button 10 times and then GT button, done. But here we are finding from 1 to 10 or 6 to 10. 6 to 10. Two approaches are there. Both I will tell you. I feel one can be done directly in calculator. One way you can do is first to do it from year 1 to year 10. First to do PVAF from what? Year 1 to year 10. Okay, maybe tell off for it. At 12%, tell me PVAF for 10 years from year 1 to year 10. 1 divided by 1.12, press equals to button 10 times. And then GT button. How much? 5.650. Okay, we need it from 1 to 10 or 6 to 10. That means year 1 to year 5 ka PVA. We need or we don't need? We don't need. That we have already computed here only. 3.605. 3.605. That is included here now. We need that or we don't want? We don't want. So eliminate that. That way you will get year 6 to 10 ka PVAF. How much is it? 2.045. That's the number. This is one approach. Little lengthy. Can I just show you how to get this directly in calculator without doing all this plus minus drama? Everyone okay? Take your calculator. Oh. Sir, for this method to work, your M plus button should be there in your calculator. If it is not there, so throw your calculator and get a new one. Or maybe do this approach. Okay, Naji. This approach will only work when you have M plus button. First, to memory you clear. You must have pressed a lot of things. MRC button 8-10 times. Taka you press. Clear memory. Memory cleared. From here a calculator. Here also, sir. Pakka calculator will remember. This one gone. And now people, how to do it in calculator? Simple. We want it from which year to which year? Year 6 to year 10. At 12%. No? 1 divided by 1.12 you do. Press equals to button 5 times first. Only 5 because we need it from 6th year, right? First press equals to button 5 times. Where it went? I have to press MRC. Okay. 1 divided by 1.12. 1, 2, 3, 4, 5. My calculator is showing 0.5674. We are also there on the same line. 5 years over. Then we need it from 6 to 10. Again, 1 minute. Do what I'm only saying. Press equals to button. Immediately M plus button. Equals to button. Immediately M plus. From 6th time onwards. Okay. Now again equals to button M plus button. 7th time. Again equals to button M plus button. 8th time. Again equals to button M plus button. 9th time. Again equals to M plus button. 10th time. Done now. Then there is MRC button. Memory recall. MRC button you press. 2.045. Okay. Calculator or this, whichever is comfortable for you. If M plus button is not working for you, either buy one or use this way, whichever you call. For normal one, use GT button. GT button is faster. But if they ask you midway, then use this M plus 1 button. Done, Sarji? Everyone got it? Okay, 11 to 15 Chapandipa. Now you tell me. 11 to 15. Oh, no. Maybe I'll tell you over here. 11 to 15, what is the maintenance cost? 39,000. Different every year or same every year? Same. Now find PVAF from year 11 to year 15. What you will do first? Press 1 divided by 1.1 to 10 times first. 10 times first. 1.161, correct. 1 divided by 1.12, press equals to, only equals to button 10 times. From 11th time onwards, press equals to button and M plus button together. Equals to M plus, equals to M plus, equals to M plus, like this, till 15. And then press MRC button. What are you getting? 1.161. Everybody is getting this. You want me to show this once or sorted? Everyone, pakka. So that is your PVAF. So mid-year, if you want to get PVAF, you can calculate like this. Now last to salvage value. How much is salvage value we got? 64. Salvage value you will get every year or once. That to end of the year, which is the year ending. 15th year. Now Guruve PVAF or PVIF? At 12% PVIF. 1 divided by 1.12, press equals to button 15 times. 0.18. Multiply and you will get the present value, you will get the NPV or present value of cash outflows. Present value of cash outflows. Because all these are what? Only outflows. Life was same or different? Life was same or different? Different. So we have to find what? EAC. We already did this. Tell me EAC. NPV alla guruve. Outflow. You want to leave now? Outflow. Present value of cash outflow divided by PVAF. That will give you your That will give you your EAC. Now, Probe, don't use M plus button. We need PVAF for what? Full 15 years. Okay, calculate. Full 15 years go, give me PVAF. 1 to 15 years go, give me PVAF. 1 divided by 1.12, press equals to button 15 times and then GT button. 6.81. Okay, now. Today calculator will be gone. The amount of Josh you are pressing. Probably you are putting all my Rosha Copa on that calculator. Okay, what is EAC, people? Present value of cash outflow, which is 7,62,927 divided by PVAF. Divided by PVAF. If you do, you will get 1,12,014. Done now. Same drama you will have to do it for ABC also. I'll just discuss the method. Would that be okay with you? But ABC ka year is not 15 years. It is only 10 years. Okay. So same tama. These two are what? Outflows. Here outflows we are presenting as positive number. Salvage value is negative because they have given a lot of outflows. In fact, all these three are outflows. Check if you want. They have taken 450, 31, 53. 450, 31, 53. All outflows positive. Salvage value, how much did we get for second asset, people? 57,000. They have taken this as negative. And you already know for year 6 to 10 how to find out PVAF. Done now. This is what? Present value of cash outflow. But this life is only 10 years. Previous ka was 15 years. Hence first find what? EAC. How do you find EAC? This number divided by PVAF. Prabhu, now don't take this PVAF. Your life was 15 years. Here life is 15 years or 10 years. Calculate 10 years ka PVAF, which is 5.65. This divided by 5.65 will give you EAC. This is option number 2 ka EAC. Once more, sorted. Get numbers you leave, but are you able to understand the process? Remaining ones, if you review, you will get it. Overall, this is good now. One more, that's all. One more option. Lease option. Rent option. Thank you, ma'am. All right. Now, this leasing or renting option, when there is a catch there. What is the catch here? You're not paying the rent at the end of the year. You're paying at the beginning of the year. I'll read that sentence once again for you if you want. So, no, sir. Hey, I want to read. Annual rent should be paid. You can take, instead of buying ABC, this is only applicable for ABC. ABC ka life is 1 year or 10 years? 10 years. So instead of buying, you can lease it or rent it for 10 years. Now, if you want to rent or take this ABC on, lease, annual rent shall be paid at the beginning of each year. First year, how much rent you will pay? 1,02,000. When you will pay? End of year 1 or year 0? So check year 0, 1,02,000 you should take. They take a year 0, 1,02,000. Okay, people. Then no, for the next how many years? Next 4 years. That is, you'll write year 2 now. No, you have to pay beginning of the year. So that means from year 1 to year 4. Year 1, year 2, year 3, year 4. How much you will pay? 1,02,500. Correct, people? See, second, when you write, instead of writing year, when you write year 2 in FM, it means end of the second year. Will we pay next rent at the end of second year or beginning of second year? Beginning of second year means it becomes year 1. Hence, for the column here will be for rent, it will be first year 0. Then next 4 years will be year 1 to year 4. Okay. Everybody good? And how much is that rent? 1,02,500. Check, have they taken 1,02,500 from year 1 to year 1 to year 4? Where is it? Here. Year 1 to year 4, 1,02,500. Done, people. And next, what did they give? Next 5 years, the final 5 years, the rent will be 1,09,950. Or simple drama is rent you copy. What is it here? 1,09,500. No, this is year 0. This is year 0. Next they gave how many years ka rent? Year 1, year 2, year 3, year 4. Automatically next will start from year 5 to year 9. So you don't have to break your head. If this stops at year 4 means next will be from year 5 only. Okay, Naji? Different every year or same every year? That means we will use PVIF or PVAF. But here careful, 5 to 9. You know how to find, no? First press equals to button 4 times. From 5th year onwards, equals to button and M plus button. And if you do it, you will get it. Okay, Naji? Correct. But don't take PV AF for 9 years. You're paying rent. No, 1 second. This one solved, no? What is this? Present value of cash, outflow. Now we have to compare all the three. First, missionary ka life 15 years. Second ka 10 years. Third option ka 10 years. Life same or different. When it is different, we always have to work based on EAC. How do you get EAC? Here outflow is given. So present value of cash outflow divided by PVAF. Just because your column ended at 9th year, don't take PVAF for 9 years. Take PVAF for 10 years. Because lease ka term is 10 years only. Rent you are paying at the beginning of each year, but lease ka duration is still 10 years. Now, don't take 9 years ka PVAF. After doing so much, don't do that mistake. So, take PVAF for how many years? 10 years. Because total lease ka or rent ka duration is 10 years only. And then calculate EAC. This is a hidden adjustment. Okay, na sir? One or two good points are there in this question. One is salvage value, finding mid years ka PVAF. And this rent ka putting the right year columns. And considering not taking 9 here, taking 10. These are some small mistakes which can happen. If you sort this out, I think done. Now people, EAC. This is EAC from benefit angle or cost angle. So you will select the one with the highest EAC or lowest. First option ka EAC was 1,12,000. Second ka 115. Third ka 117. Which is the lowest? 1,12,000, no? So first option was that the brand XYZ, no? That is a decision. Since equivalent is least in case of XYZ, that should be purchased. Okay, now. Examiner was not satisfied with this. What did they ask? One more. What is it? State the option which is most economical if the machinery is likely to be used for 5 years. Previously, they told we want to use it for 20 years. But anyway, the life was only maximum 15. So we did it at 15, 10 and all. Here now they are saying work out every option when we want to use it only for 5 years. That means you tell after 5 years any data you will take a cut it off. You have to take the data only from year 1 to year 5. Manageable. Everybody good. Salvage value, this one can you take? No people, this was a salvage value for 15th year. I mean same working note you have to put for 5th year. 5th year. Calculate. Same. Let's see. Same. Salvage value should be dropped by 1/3 for of purchase price for first year. Thereafter depreciated for first asset at 4%. Calculate. Let's see. I don't know. I'll cross check. You tell me. 3,04,000. 3,04,000 it seems. Here also they've got 3,04,000. Anybody needs help in that or sorted? Pakka no. In fact, if you just need it, here you will take what? You will take depreciation from year 2 to year 15 or year 2 to year 5. Year 2, year 3, year 4, year 5. So you will multiply by 14 years or 4 years. 4 years. That's all. That's the only change. Okay, here also same thing. You will multiply not by 9 years but by 4 years. Rest calculation is same. I hope I don't have to show that. Correct na people? Now, sir, if everything is on 5 years, I don't need EAC. We are working second option. We are working second case. All the three, we are working for what period? Period. Sir, EAC is required only if period is matching or not matching. In second option, everything we are working at what period? 5 years. EAC required or not required? Even if you calculate EAC, everything you will divide by PVAF for 5 years. Even if you do it, not a problem, but not required. That means you can answer based on present value of cash outflows. Clear? So that I have to show or manageable? Manageable. You can manage pakka. Now, 1 minute. Wait. Lease option, you have to take it for 10 years. Lease option, you have to take it for 10 years. Before 10 years, if you cancel, there is a penalty. Don't forget penalty. So in the next option, you will also get a penalty. How much is the penalty? 1 lakh. They didn't leave it at that. They said each year you use the asset. Each year you continue the lease. Penalty will reduce by 10,000. So that means what is the penalty? Penalty will be 1 lakh. Provided you cancel first year only. Did we cancel first year or 5th year? That means we use the asset for how many years? 5 years. That means penalty will reduce by 50. So penalty will be inflow or outflow? So one more outflow will come for which option? First option purchasing, second option purchasing second asset, third option leasing. This 50,000 will come for leasing. Where is it? Here. Outflow. Done now. So where is salvage value? Hey, this is leased. Lease where will salvage value come? Other two salvage value will come. Okay, here instead of salvage value, what will come? Penalty will come, but as an outflow. Good question. Doubtful that such a lengthy question will come. In class only we took almost 1 hour to solve this question. More than 1 hour. Okay. But doubtful that easy only. But since you have to work out for so many options, becomes a little lengthy. Overall, I hope it was comfortable for you. Yes, people. Yes, so with this, so finally investment decisions we have put out. Tatastu. Thank you. Let's take breakfast break and resume back. Thank you.